Welcome to my multiple hours full free options trading retirement course for beginners. Yes, it's a couple hours, but it's going to be totally worth it because I noticed there's nothing on YouTube that's beginner friendly and shows a detailed way to grow and scale a retirement portfolio with examples of closing, managing, and opening positions properly. I want to make sure that this course right here teaches you everything, even if you're a complete beginner, to help you understand how to make money option trading. Here is a full list of timestamps for everything that I'll be covering in this course, as well as you can find them on the YouTube play bar. I could easily charge and have charged thousands of dollars for this type of education, and now I'm giving it away for free. And this full course is especially designed to take you from a complete beginner, even if you don't know about option trading or don't even know what an option is, to a confident option trader equipped with the knowledge to create a stable, consistent, and pretty much completely passive income online. This way, you can retire early with options. That's exactly what I've achieved after many years. And yes, it does take many years to actually scale up a portfolio to 7 figures. And I'm not going to sell you the fake dream and tell you that this is going to happen overnight or this is possible in just several weeks. Option trading is risky. Option trading takes a lot of skill, time, dedication, but it's absolutely worth it if you learn the skill and apply this knowledge properly. It only takes about 1 hour per week to actually scale a passive, stable income in my personal experience after I have coached thousands of students. I have 12 years of experience and I started at 19 years old with just $2,000. Now, my portfolio sits at $4 million steady while I withdraw money every single month that I make in terms of option premium that I sell or growth that I experience within my portfolio from options. And this has allowed me to travel around full time while taking Zoom calls and researching stocks anytime during the day that fits my personal schedule. So my goal is to help you learn this on a deep level so you can apply this knowledge and grow your own wealth without taking on too much risk, without buying dangerous companies, without experiencing crazy volatility. My goal is to make this process as smooth as possible for you. I don't say this to brag. I'm saying this to show you that anyone can do this. So with that being said, let's jump in and learn how to actually trade options. So first of all, what is an option and how is it different from a stock? We know that buying a stock equals a small piece of a business. That is what buying a stock is. You have a very tiny fraction ownership of an entire business. And what we want to happen is we want that business value to rise. When you buy 1 share of Nvidia, you own a tiny piece of all of Nvidia. And when you invest $100 into the stock and the value of the company rises, your value goes to 101, 105, ideally higher, 110, and so on. That's what you want to happen with the stock. Now, let's say that you buy an option contract. An option contract is very similar to buying stock. Instead of buying the shares, you buy an option, and that option gives you the access to those shares. Think of an option as a levered tool, okay? Imagine you have a lever right here, and when I push the lever down a little bit on the option, the value of the stock goes up a lot. It also falls if I push the lever up, okay? A stock isn't a lever, it just moves up and down and goes sideways potentially. All right, let's recap the basics and then discuss my retirement framework. Stocks versus options. Well, stocks move dollar for dollar with the share price, while options act like a lever, as I showed you earlier. A small move in the stock can create a much larger percentage move in the money. For a call, when the stock price is above the strike price, we will say that it is in the money because it's above our strike price when it's higher. An out of the money option for a call is when the stock price is below the strike price. Now for expiration date, that is the last day the option is valid. Expirations range from 0 DT, meaning that option expires that same day. There's 0 days to expiration. That's what DTE stands for. To even multiple years. A long-term option can expire 2 years from today. And then we have exercise, which is the option buyer chooses to use their right under the contract terms. And they decide to exercise their right, whether it's a call option or a put option. Then we have assignment, when the option seller is required to fulfill contract details because the buyer is exercising. Next in our recap is buyer versus seller. The buyer pays a premium for the rights and the seller receives the premium in exchange for taking on the obligation if exercised. The option market is not much different from your standard stock trading strategy. An option trading strategy or the option market is only a little bit different from the stock strategy in the sense that you're still trading the same stocks in the same market. Just the option market behaves a little bit differently based off of the option that you choose. I'm going to answer all of your questions right now. I'm going to go into my Robinhood portfolio. And throughout this whole video, I'm going to show you real live examples. By the way, Robinhood is just a financial app and platform. You're welcome to use any trading platform that you want. I'm just a coach showing you. If you do want to learn from me personally, by the way, there's a link in the description for my Discord community. Now, let's get into it. All right, here is my platform. Here's Robinhood. I'm going to briefly go over it, show you some of the things that I'm doing. And then I'm going to go to an option chain and show you how an option chain works and how, call and put options work. So basically, here's my portfolio. Over the last 1 week, I'm pretty flat. And over the last month, I'm pretty flat. We've been in some very volatile times. However, so let's scroll down here. And here are some of the options. I have very many options in my portfolio. You can see the ticker symbol right there, AAL, Nvidia, CMG, SoFi. These are all the stocks I'm holding. So American Airlines, Nvidia, Chipotle, SoFi, Nebius, Iran, Archer, which is ACHR, Palantir, Robinhood, Google, Amazon, and then other options. And you can even see it says ITM if it's in the money or not. You can also see some of the gains or losses that I have here on my positions. Now here's all the stocks that I'm holding. You can see all the different positions that I have. For example, if I click here into Walmart, Walmart here shows you the trading price, shows you the graph, and you can also see my personal position here. I actually have $1.2 million in Walmart stock, and I'm up $436,000. I told my community since the very first day that I purchased Walmart that I thought this stock was overvalued, and I ended up being right over the past year or so on this position. So it's done really well despite Walmart not being a sexy company or an AI company. You can do really well without having to even go for high risk stocks. Now, what I want to show you is if I click here, trade, and I go to trade options, now you can essentially see what an option chain looks like. So I can pick an expiration date. So let's say I go for an expiration date in 2027. Let's say I go for June. Now let's say I have several options. I can either go to buy call or sell call or sell call or sell puts. I can buy puts. There's only two options. There's calls and puts. Either you sell them or you buy them. That's it. So option trading isn't too complicated. I think you're really going to understand this even if you're a beginner. And many people think that option trading is super complicated or super risky. Well, it is super risky if you do it incorrectly. If you trade options incorrectly and you're buying options and you're trying to go for home runs, then yes, you can end up losing a lot of money option trading if you don't do it properly. But if you do it correctly, you can actually create income from options by selling them. You can collect premiums on a monthly basis or a weekly basis. You can actually hedge your positions, reducing the overall risk. If you're a stock investor, if you have stocks, you can actually use options to reduce your risk. So there's a lot of versatile ways to use options in your portfolio. The way that I'm going to be teaching you in this video is more so using options as a retirement strategy and generating premium income. All right, now let's get into section 2 of our course, the retirement problem. So there's a really huge retirement problem. There is a lot of people going for the traditional path, and the traditional path historically is just honestly having a job, saving money, working super hard, having a boss, investing in a 401k or a retirement account, and waiting multiple decades, sometimes 40 years. And then many people have to, at that point, follow a broken but very common financial advice, which states that you should take 4% as a safe withdrawal rate. The 4% rule that I'm referring to came from the Trinity study back in 1998. Trinity University tested withdrawal rates from 3% to 12%, and they used different stock and bond allocations. Retirement periods 15, 20, 25 years, and 30 years, and their results was that 4% had a very high historical success rate over a 30-year retirement window, meaning that if you're withdrawing 4% from your portfolio, it should last you 30 years. Well, that's just not that good, and it's just not that attractive to me personally. That was my mindset when I was learning the options. So unless you have millions of dollars, well, this isn't really that realistic. And even if you do achieve millions of dollars, taking out 4% per year doesn't really seem like a whole attractive amount of money to be withdrawing from your portfolio, especially today with high inflation, high cost of living in the job market that has very high unemployment rates. And what's even crazier is that many researchers are now arguing that 4% might be aggressive. They're saying that 3 to 3.5% may be more conservative because of today's valuations and lower expected returns moving forward. So let me tell you this, I definitely didn't want to be waiting 40 years to retire and live on a small 4% per year withdrawal rate. You're telling me that I have to work my tail off, go to work all the time, save a lot of money, be very frugal, live below my means, save for decades just to have a life that honestly doesn't even compare to the men in the 1950s or families in the 1950s. Because in the 1950s, a one-person household was able to support an entire family. A man was able to own a house, have much more freedom than today, take care of his family, and have way more freedom than today. So I thought about this and I was like, no thanks. I need my investments to produce a lot for me, and my search for high growth and achieving retirement help me build my retirement framework. So let's talk about the first pillar, which is cash flow. This one is super exciting. By the way, before I jump in, if you're someone looking to build an option portfolio and scale it, one-on-one coaching and live trading is my program that has helped over 1,000 busy professionals build monthly income and solidify their retirement. I don't just have a Discord where I send trades and technical analysis, although I do that as well. I figure out a custom solution for each investor and work on helping them through their financial journey. You can find more information in my description. Now, let's keep going with this course. Section 2.2, cash flow changes everything. And literally, lots of rich people can be very cheap and they don't even have that much freedom to spending their money. Hard-headed people that save, and honestly, they've been spending decades of their life just saving money and being extremely frugal, but their standard of living isn't that high because they're overly frugal. And honestly, I don't always blame them because part of their issue is maybe they have built a lot of wealth and they have a lot of net worth, but they don't have a lot of cash flow. Being frugal is fine and smart, but if you can live more comfortably without having to cut your expenses and count every single dollar, that is a lot better. For me, when I shop at a grocery store and I don't have to look at prices, I consider that a form of freedom. So what's on sale? Blueberries or raspberries? Well, I just think, let me get both if I want both. So I measure wealth in cash flow, not in net worth. Monthly cash flow is my personal goal with option trading. And that's also what I like to teach because most people, they don't want to have a huge net worth. They actually want to have enough money to not have to work and to have more freedom in their life so they can spend time with their family and they can make more choices in their everyday life. So wealth isn't just how much money you have, it's how much freedom your money gives you. When your monthly income exceeds your burn rate or how much you spend per month, well, then you're finally in the retirement zone. And then you can continue working if you want to work, or you don't have to work if you don't want to work, right? So you can have a whole $1 million in your portfolio and you can still feel financially stressed if it doesn't produce enough income. Or you can be like one of my students, Denny. So Denny has a $300,000 portfolio and I've been working with him for many years now. And he receives about $6,500 in option premium on a monthly basis. And he spends his entire day with his family. He is in full retirement. Denny isn't generating crazy money, but Denny has a comfortable retirement. It's all about how you make your money work for you. So we will discuss simple option strategies in this video, but we're also going to build up to more advanced strategies such as spreads, buying strategies like bull call spreads, and leap options as well, plus technical analysis, as well as managing your positions properly. When to take profit, we're about to get into all of that in just a moment. All right, let's get into the next chapter. Let's talk about the 3 core strategies. Here's an overview of the 3 core strategies before we get into the growth strategies later on in this course. The 3 core strategies are cash secured puts, covered calls, and credit spreads. So let's discuss what these 3 strategies are and how I use them. A cash secured put is one of my favorite strategies because you're getting paid to buy stocks that you already want to own. Instead of placing a limit order and waiting for the stock to come down, you sell a put option. If the stock never reaches your price, you simply keep the premium. If it does reach your price, then you buy the shares at a discount while still keeping the premium that you collected. Think of it similar to getting paid to wait. That's an awesome way to buy a stock that you want to own anyways. So when do I use it? I use cash secured puts whenever there's a high quality company that I would genuinely be happy to own more shares of, or I would genuinely be happy to enter into a position on. This strategy works best when you already want to own the stock, the company has strong fundamentals, or if simply implied volatility is elevated and you want to purchase the stock for lower than it's trading at in the market right now. There are 3 major advantages. I generate income even if I don't potentially buy the stock. If I get a side, my effective purchase price is lower because of the premium. And third, I remove emotions because I've already decided at what price I'm willing to own the stock. And that third one is really important because so many investors, they change their mind once the stock fluctuates in price. But if you do your research, you determine you want to buy that stock at that price, then selling a put option is very similar to just setting a stop loss order. A stop loss order is very similar to a limit order. A limit order is basically when you enter a limit price and you say, I'm only going to buy at that price. Well, selling a put option is essentially almost the same thing. You're basically just setting a limit order saying I'm only going to buy it at this price, and you actually get paid for it. This is why I consider this an overpowered strategy. Now, once you're selling the shares, the strategy doesn't really end. That's where the next strategy comes into play, which is a covered call. A covered call is simply selling an option against your shares that you currently own. You're allowing someone else the right to buy your shares at a price that you choose. In exchange, they pay you cash up front. It's like collecting rent on a property that you already own. I sell covered calls when I already own 100 shares of a stock. I'm comfortable selling it at a higher price, or if I expect the stock to move sideways or rise slowly, a covered call is a good strategy in a sideways market as well. A covered call is a moderately bullish strategy. So basically, if the market goes up, you have to sell your shares at the strike price that you choose. If the market goes sideways, well, the call option will expire worthless and you can do it all over again. If the stock market goes down, or if that stock goes down, well, you're just going to be in a very similar situation as someone holding a stock, but you actually have some cushion and some premium that you collected from the call that you sold. Covered calls create an income stream due to the premium that you collect when selling a call option. Instead of only making money when the stock rises, I'm collecting option premium every single month while continuing to own the shares. If the stock reaches my strike price, I simply sell at a profit that I was already happy taking and getting out of the stock at the strike price that I selected. Now, the next strategy is a really cool one because it's for small accounts. Do you currently have a small account? Well, then credit spreads are amazing. A credit spread is a defined risk option strategy where you sell one option and buy another option further away. The purchased option limits your maximum loss because your risk is capped. You need far less capital than selling options or cash secured puts. Now, credit spreads are ideal when my portfolio is smaller and I want a defined risk. I have a neutral to moderately bullish or bearish outlook depending on which call credit spread or put credit spread, which we will talk about later, I'm selecting. And overall, my goal is just that I want capital efficiency. Now, there's 3 reasons to do spreads. First, I know my maximum loss before entering the trade. Second, I can generate income using much less capital. And third, I can structure trades for bullish or bearish markets. Throughout this course, we're going to learn each of these strategies individually. Then I'll show you how they can work together in a diversified option portfolio with a strong focus on risk management. And then when I put it all together, it's honestly going to be life-changing. So let's get into the next section, 3.2. Why isn't everyone doing this? Well, most people assume that if selling options can be effective, everyone would already be doing it. Well, the reality is there are several practical reasons why this isn't a strategy that is widely taught on YouTube or out there in the world and not even used that widely either. It's because traditional education does an excellent job at teaching math, science, and history, but very few schools or universities are actually teaching practical investing. My belief is governments don't really want people to have info, power, or knowledge that would take them out of the most important role of being an employee. That's what the government wants. And individuals have to take their own financial education into their own hands. Now, from the financial advisor perspective, many financial advisors build portfolios around long-term investing, ETFs, mutual funds, and retirement accounts because those approaches fit a wide variety of clients with different goals and risk tolerances. It's not like your financial advisor wants to really work that hard to get 1% fee, which he's going to get whether he works hard or not. So I actually think there's a misalignment between the financial advisor, between universities, between basically everyone from teaching you how to actually be self-sufficient, which is one of the most important things that you can personally do for yourself. This is why I always say in my videos, it's better to be in control of your own financial future and managing your own money. And I became a coach after working for Goldman Sachs and Wall Street because I didn't really believe the money management model of taking clients' money and charging ongoing fees as a percentage of assets was really aligned with everyday people who are trying to build wealth. Much of the investment industry has historically been around managing assets. Different firms earn revenue in different ways, such as advisory fees, fund expenses, or other management services. Learning to manage your own portfolio requires time and education, and that's something that not everyone is willing to put in. So if you're watching this, I want to congratulate you because you're a real person who has the right mindset, which is super important. Whenever I'm working with one-on-one students and we have an application call, which is down in the description, people apply, we have a call where we show you everything. We're not only showing you everything, we're also interviewing you because I don't want to work with everyone. Someone who has a bad mindset or basically wants to double their account overnight and wants to take dangerous plays, high risk plays, that's not someone that I would would want to work with because they don't have the right mindset. Which brings me to my preference for the best retirement strategies and how I'm teaching this course. And the mindset that I'm going into this course is I prefer slow riches over fast riches. Trading takes dedication, consistency. The risks are high when an investor takes the wrong path, whether it's the bad stock selection or simply mistiming strategies from the core that I'm going to be teaching you as we continue, or the growth strategies later on. So I'd rather get rich slow than trying to get lucky. All right, let's get into the next section, 4.1. This is going to be live examples, and we're going to first of all go over buying a call option. A call option gives you the right but not the obligation to buy 100 shares of a stock at a predetermined price before the option expires. So let's open up my portfolio. Here it is, and I'm going to go search for a ticker symbol, and we're going to be looking at buying a call option. Something we can look at is some big movers on the day. So let's see, any big movers that I like. Well, we're just going to use Amazon. All right, so once we go into the stock, I'm going to go to trade and then trade options. And now all we're going to do is demonstrate how buying a call option works and the payoffs on a call option, how the option actually fluctuates when the stock fluctuates, and what do some of the terms mean when we look at an option chain. So I'm going to go for a call option that's going to expire on September 18. Remember, if you're watching this in the future, no problem. Just take in the same logic, the thought process, and apply the methods that you're learning from this course to your own portfolio at the current time if you're watching in 2027 or 2028 as well. So, okay, buy call option. Okay, that's the most important thing. By the way, don't get this wrong, because some people, they go into option trading and then they end up like doing the wrong button pushing. Just do it step by step. Take your time. Okay, so buy call option. Okay, and this is basically the strike selection that we have. Okay, so let's say that we're bullish on Amazon, and Amazon is trading right now for $247 per share. So with a call option, we profit from an increase in the stock while using less capital than buying 100 shares outright. So if we had to buy 100 shares, it would literally cost us like $25,000 essentially, right? Let's just pretend Amazon's right around 250. It's at 247, close enough. So it's going to cost us like $25,000. That is expensive, right? But with the call option, the numbers that you see on the right-hand side is basically just the premium that you're having to pay to control the same 100 shares. So way less capital that you have to put up, and you get the same control. And of course, the only reason why you're able to put in a lot less capital is because an option has an expiration date. So if it doesn't go in your favor, well, you can be in store for some trouble. And we're going to talk about managing, so we're all good with that. Look, so let's say that we think that Amazon's going to go a lot higher. So we can go for an out of the money option. Let's say 270, okay? I'm going to click into the 270 and show you. So the 270 strike price here is expiring on September 18. You can see that at the top, it says 918. Now, on the bottom, you'll see there's Greeks. On the top, you'll see bid and ask, and there's mark and previous close. Let me just go step by step here. First of all, at the very top, bid-ask spread. This is essentially, the bid is where investors are trying to buy this option, okay? People want to buy it for $735, okay? Imagine going into a car dealership and you want to buy a used Toyota Corolla for $7,300. But the guy selling you the Toyota at the dealership is like, I want $7,555. You're like, man, I want to pay $7,300. He's like, I want $7,500. And you guys are arguing back and forth, and eventually you agree on what? The middle price, right? You agree on the center price. So you go for $7,450, the mid price, right? Which you can see is the mark, okay? It's exactly like that. The bid is someone trying to buy, the ask is someone trying to sell. If you want to execute on this trade, you're going to want to go for the mark price or the mid price, okay? So that's where the mid is coming from or the mark is coming from. Previous close is not that important. It just means what the option closed for yesterday. So today we're kind of getting a discount because it previously closed for $850 and today it's phoned for $745. Okay, the chance of profit here is 21%. This right here is not a number that I'm using on Robinhood. It is not accurate as far as I'm concerned. The number that I personally use that actually matters is delta. The delta here is 0.32, which actually puts my chance of profit at 68. I'll tell you why. 32 delta is telling you the chances that the option will expire in the money, or the probability that this option will be in the money or profitable in general. Okay, so 32.32. Okay, the inverse of that, so this is 32 success rate. The inverse of that, 68% chance, means that this will not be in the money. There's a 68% chance that it won't be in the money, a 32% chance that it will be in the money. Chance of profit here, I don't know why it's so incorrect here. So yeah, 21% is not correct. What's actually correct is the delta. Delta is the most important Greek that we will discuss much more as we continue this course. Delta is incredibly useful. And another definition of delta, by the way, is if the stock moves by $1 and the delta is 0.32, well, the option is going to move by 32 cents. Okay, so delta is also measuring how much the option fluctuates. Very important. But essentially, to make this super easy, this Amazon 270 call that I'm buying for $7 will have a break even of $277. You can see that right there, break even $277. So above $277, it's all mine. Every single increase above $277 is what I'm going to be making. Now, that is at expiration, and we don't need to hold options until expiration. We can sell an option early if we choose. In fact, we can buy one and we can sell one after minutes if we want. Okay, that's not the best strategy, and we'll talk about how to manage a leap call option, how to manage a regular call option, how to manage every single one of these strategies. We're going to go into great detail, but for now, basically you can get in, you can get out whenever you choose, whenever you want. I am personally typically not holding until expiration, especially when I am buying options. And now the flip side is correct when I'm selling options. When I sell an option, I am typically holding until expiration. When I sell an option, pretty much I want it to expire, and I want it to expire worthless. That is kind of my ideal case. When I'm buying an option, I want the stock to move in that direction as fast as possible, and I will set a profit target. Now, we discussed buying call options. Buying call options is a very bullish strategy. We want the stock to rise, and we want the stock to rise in that upward direction as fast as possible and as much as possible, and that would increase the value of our call option. Next is selling a call option, a covered call. A covered call involves selling a call option against shares that you already own. In exchange, you collect option premium up front. So check this out. You can already see I have a short call option here, which means that I have sold covered calls. You can see negative 15. You might be looking at my screen. You're like, well, why does it say negative 15? I actually have 255 calls that I have sold. So I have sold covered calls. I'm going to go back into my Amazon position right now. You can see I have 2,800 shares. I'm up $117,000. Now I'm doing something really interesting. Okay, I have 15 contracts of 255 calls that I've sold or covered calls. Okay, I could sell more, by the way. I could sell 28 contracts and I can have 28 covered calls because I have 2,800 shares. However, I'm doing something interesting where I'm selling a partial covered call. So you can sell a covered call. You can sell one for each 100 shares that you own. So if you have 100 shares, you can sell one. If you have 500 shares, you can sell 5 covered calls, and so on and so forth. But you don't have to sell covered calls in your entire shares because a covered call lets go of the stock if it goes above your strike price. And I ended up doing a partial fill. Okay, so I sold 15 contracts on Amazon, my 2,800 shares, because I'm comfortable letting go of Amazon at 255. But if it goes much higher than that, I might not want to let go of all my shares. I'm just going to let go of some of my shares. Okay, so let's go back here into trade options. Let's say that we were going to sell more covered calls from scratch. Okay, let's say we have 100 shares of Amazon. So I just go for an expiration date. Let's go for September 18 again. And now I want to go to sell call. Okay, so if I sell a call, I'm selling the rights to my stock if it goes above the strike price. Amazon is at 247 per share. I am selling my rights at 255. So that's not a bad situation to be in. Let's say that I'm happy to get rid of Amazon for 255, or even better, let's just say I start a new position today. I buy 100 shares at 247. I sell this covered call at 255. So I'm agreeing that I'm at 247 in terms of my entry price. At 255, I want to get out. And still, I have a premium that I haven't mentioned yet. The premium here is what I collect up front. As soon as I open the position, I collect premium. Now, that is amazing. Tell me this is not like almost like too good to be true. It feels like that, right? Well, the reason why this is the case is because there are some investors out there and traders that are willing to pay money to buy a call option, which is what we just talked about. Investors are betting on something to happen. And what's cool with the covered call is you basically need something to not happen. And even if it happens, you're not really in a bad situation. If it happens, you get rid of Amazon at 255. If it doesn't go to 255, you just hold the shares, which makes you just a regular stockholder. But now you're a stockholder that's collecting option premium income. That is the path that I'm currently taking to be in retirement. That's how I'm generating monthly income, and that's how I'm retired. This is one of my core strategies. I own lots of stocks. I built my portfolio over a decade. I've taken probably like 10,000 plus trades in my life. And this strategy right here has contributed significantly to my own retirement and my own stability, because if I own a stock that I like, but I don't mind selling it if it goes higher, I just sell covered calls. And by the way, we will talk about a management strategy which will allow me to not even lose my stock later on when we discuss rolling in this course. But simply said, this 255 call, I am collecting premium. I have the risk to lose these shares if they go above above 255. But maybe I'm comfortable taking that risk, or I can manage that risk by rolling and adjusting the strike price by paying potential money. Maybe I even have to lose some money for a benefit that might be much larger than the money that I pay for the adjustment, which is exactly what rolling is. I'm giving you some foreshadowing into the cool process that we'll discuss later on. But 255 here, covered call, it goes to 255. I have to sell at that price point, and you will see that the total benefit I'm actually getting is not only that I'm getting out at 255, but the premium of $12 effectively, very important, one more time, effectively makes my exit price at $267 per share, because I'm adding the $12 in premium to $255 strike price, which effectively gets me to $267. So you can kind of say, in other words, you can buy the stock at 247 and then you can sell the stock at 267 in the covered call scenario that we're going over. So this example is very interesting. Let's move on into the next example, and let's pick a different stock here. I'm going to go for SoFi. I want to pick SoFi here when I show you what put options are. So the next retirement strategy that I want to discuss is selling a put option. Okay, so here is SoFi. It's been going sideways. It hasn't been doing too much. I do really like this company overall, and this is not a stock picker's course or anything like that, but some of the things that I look for in a good company is high growth rates, good revenue growth, good earnings growth, which is EPS, which is the most important thing, which will take their PE ratio lower. And overall, a company doesn't have too much debt, that's managing their balance sheet correctly, growing their cash flows, and building their business. It's really as simple as that. SoFi is doing that. And another thing that I like about it is that it's a fintech company. It's disrupting markets. So they have a disruptive business, which is disrupting some of the older banking models. So, very good, innovative company overall. But let's go to trade options here. And let's just go for something short term. I'm going to go for August 21st, which is basically, I'm in August essentially right now as I'm making the video. And I want to show you what this would look like. So a put option gives you the right, but not the obligation to sell 100 shares at their predetermined price before expiration. Okay, that's buying a put option. People are betting on it going down. A buy put option is not something I'm going to really get into in this course, because buying a put option is just a risky bet that something's going to fall. And buying put options is essentially, I believe, to be more so gambling. You're just betting on a stock to crash or fall, and it has to fall in a short amount of time. So that's what buying a put is. It's dangerous, it's risky, and you can just basically lose all the money that you pay for a put option. On the flip side, if you sell a put option, it's very similar to insurance. You're essentially collecting a premium where you're selling insurance, because again, someone who's buying a put option is either afraid of a crash or they're speculating or gambling on the stock coming down. So by selling a put option, you're selling insurance, and you're stepping in and saying, hey, if the stock crashes or comes down, I will be buying those shares from you, or I can buy the put option from you, right? So here, when I sell a put option, I'm essentially saying I will have to own 100 shares for every single put contract that I sell. So if I enter this 17 put option and I sell a put here, okay, I'm essentially saying, SoFi, if you're below 17 on August 21st expiration, I'll buy you for 17. So if the stock is at, 14, I'll have to buy it. But also I'll have to buy it if it's at $16.98. So if it's $2 below 17 at expiration, I'll also be getting assigned. And if you think about it, that's not a bad situation to be in, because the premium that we're collecting is $1. And by the way, this dollar, this is how much it represents. I'll take $1, I'll divide it by 17. And this percentage that you see on the screen is represented by how much premium I am collecting for taking on this risk. So I'm taking on a risk to buy SoFi at 17. By the way, very, very important, mind you, that the stock barely even goes below 17. Its bottom here where it had a huge run up, had a huge bounce, was at 16.95. And we'll talk about technical analysis later on, but simply said, whenever you sell a put option, if you find the support level and you sell a put option at the support level, that's as close as like the, juicy steak from a nice restaurant for, $2. That's a deal, man. You know what I mean? Like, that's a deal. That's something that I like to see. That's how I like to enter sell put positions. That's what I'm interested in. And that's what I do in my community. I'm trying to find bargains. I'm looking to collect premium without taking on too much risk. That's the whole goal of finance and investing. It's to manage your risk and reward, to manage the amount of money that you make and the volatility that you experience. And the better that you get at that, the better it is overall for your long-term retirement. There's so many option channels now coming out. I see all these YouTube channels without credentials, copying content or using AI to make content, and they seem good. They have flashy titles and thumbnails. Their information is even good because it's ChatGPT, but they don't get into managing the risk. They don't get into risk risk reward ratios. They recommend some stocks, they recommend some strategies, but how do you actually manage that? That's where the whole difference comes in, right? I mean, you could teach anyone how to do well when the market's doing well, but what about when the volatility arises? What about long-term management? What about actually planning for the future and managing your overall portfolio in good times and bad times and in sideways times? Okay, so managing is where all the, real secret sauce is. I'm not teaching you anything super revolutionary with these strategies. These strategies I've taught for 6 years on YouTube. I have other free courses here that I've been coaching on, but the management that I'm getting into in this video that I'm not prepared for at all, I'm just telling you from my personal experience over, about 12 years now, is what's really life-changing. It's what really will make a difference in your life versus following other people who don't have the credentials, who don't have the 12 years of experience, who are regurgitating information potentially in a really, really good way. So I want you to really understand that managing is really where the practice is, okay? It's like being a doctor. I work with many doctors and I love working with doctors. A doctor who graduates medical school, who now goes into work, is actually still practicing medicine. And it's a practice because things are always changing, okay? So we are practicing option trading. I make mistakes every day, but I'm also still improving. And although I'm in retirement, it doesn't mean that I can't become more efficient, better at my own investing, and better at teaching investing. Okay, so that's what I want to really come across to you as. So really, that's the type of mindset information that I want to come across here. So look, 17 sell put. If I go into this option, this means that my effective break-even price is going to be slightly under $16 per share, which is amazing. That means that my effective average cost is going to be, let's say, $15.98. It's showing $15.96, but if it's $1.02, it's really $15.98. So this is selling a put option, and really there's only a couple of situations here, which is either it expires out of the money or it expires in the money and I get assigned on the stock that I want to own, and the premium is mine regardless. Basically, my average cost is my strike price minus my premium. Alrighty, let's get into the next section, which is why buyers lose. Here's a study from Stanley Choi and Kin Kyung Lee, and I'm going to show you just a few studies here in this video, not too many, but what's interesting here is that on average, they have determined that 3 out of every 4 options held to expiration expire worthless. The same research study also made a statistical analysis of options in 5 different markets: the S&P 500, the Nasdaq index, Eurodollar, Japanese yen, and live cattle. And the author concluded that for both puts and calls traded in each of these markets, options expired worthless, outnumbered those expiring in the money. Now, a totally different study, which is from the National Bureau of Economic Research, studied a data set which contains detailed daily open interest and volume information for each equity option listed on the Chicago Board of Option Exchange from 1990 through 2001. The reason why I found this study so interesting I want to show you is because this study of 1990 to 2001 includes the very risky time period in stock market history, which included the dot-com bubble. And this economic research study of options market found that retail investors held roughly 4 times more long call option positions and long put option positions, and less sophisticated investors dramatically increased their call buying during the late 1990s technology bubble. The study suggests that many investors are naturally drawn to buying upside exposure even during periods of elevated optimism. So essentially the conclusion is far too many people are buying options and far too little people are selling options. And these are just 2 research reports. I'm sure if you wanted to use AI or dig through the internet, you can find dozens of research supporting this same evidence. Now, from my own practical experience from working on Wall Street, Goldman Sachs, and 2 other hedge funds, I've discussed this many times because in the stock market, you learn in college and from textbooks and from even PhDs that the market is very efficient. There's not that much ways to actually make money in the market from, short-term arbitrage or finding opportunities. That's really reserved for people that have advantage information or advantage software access. Everyday retail investors, it's pretty difficult to outperform the market. And that's why I've been doing lots of research throughout my entire career since I was 19 years old to now, my mid-30s on how to beat the market. How do I perform well in the market? How do I reduce my risk? How do I, get rid of some of the dangers within the market and optimize my risk to reward ratio? And a lot of my research and my experience has pointed that option selling outperforms option buying. So my take take is this doesn't mean that option buying is bad. Okay, option buying has a time and place, and in fact, my best growth strategy is a call option, but just done in a specific deep way. Okay, it's called a deep, which is something that I kind of came up with, but we'll discuss that later on. But that is one of my favorite strategies. But I'm using correct position sizing and I have the proper risk management process in place. That is really important. So my takeaway here and what I'm building for you in this course is that option selling is preferred for retirement. Now, the growth strategies to get into retirement, but buying strategies do have a time and place. Professional traders buy options every day for speculation, for hedging, and for volatility trades. The point is simply that buying options requires several things to go right at the same time. Direction, timing, magnitude of the move, and implied volatility. Very important chapter in this course, implied volatility. So we will talk more about these factors later on, but professionally, I prefer strategies where time decay is generally working in my favor, which is why this course is focused primarily on cash secured puts, covered calls, and credit spreads. And then the growth strategy that we're going to use is not going to be a short-term call option, it's going to be a long-term call option, which is going to be called a leap. All right, let's make a quick bonus chapter here. So why sellers actually win? We need to discuss time decay, and we need to understand how time decay works. Here's a chart of time decay. You will notice that time decay starts off relatively slow, but it accelerates significantly as expiration gets closer. This is exactly why option sellers have an edge, because every day that passes causes the option to lose value, all else being equal. As the seller, that time decay is actually working in our favor, allowing us to potentially buy back the option for less than you sold it for and let it expire worthless. Imagine you own a hotel room for tonight. At 9 a.m., that room still has plenty of value because there's an entire day for someone to book that room. But as the day goes on, 3 p.m., 6 p.m., 9 p.m., the chances of someone paying full price for that room gets smaller and smaller. By midnight, if nobody booked the room, the opportunity is gone forever. Hotel rooms are a perishable asset. Every hour that passes reduces their value. Options work in a very similar way. As expiration approaches, there's less time for the stock to make a significant move, so the option gradually loses value. As an option seller, you're collecting a premium from an asset that naturally depreciates over time. Now, the next advantage option sellers have is probability. Every option has a probability of finishing either in the money or out of the money by expiration. As option sellers, we want to sell options that have a high probability of expiring worthless. Why? Because if options expire out of the money, we keep 100% of the premium. Let's look at an example. Imagine a stock is trading for $100. If I sell the $90 put option, the stock has to fall more than 10% before expiring for that option to finish in the money. That's possible, but statistically, it's less likely than the stock simply staying above $90. The same idea applies to covered calls. If I own shares at $100 and sell the 110 call, the stock has to rise above $110 before expiration for my shares to be called away. If it doesn't, I simply keep my shares and the premium. This is why so many professional option traders don't choose strikes randomly. They often use probability or delta to select strikes with a high chance of expiring out of the money. For example, a 20 delta option has roughly an 80% probability of expiring worthless. Doesn't mean that you'll win 80% of the time exactly, but over hundreds of trades, the probabilities tend to work in your favor. Think of it like a casino. A casino doesn't know whether you'll win the next hand of blackjack or not, but it does know that after thousands of hands, the odds favor the house. In fact, when I was studying statistics back in college, my professor made a funny analogy that when someone comes into the casino, if they end up making many small bets, the casino loves that. But if you come in with a $1 million bet your entire retirement, you bet it, on blackjack, they're afraid because there's a chance, a random chance, that in the short term, they may actually lose. This is called the law of large numbers, and in the long run, probability ends up winning. Option selling is very similar. We don't need every trade to be a winner. We simply need the probabilities to be on our side over a large sample size of trades. Now, to get a little bit more advanced, my third reason and my third pillar of selling options is implied volatility. Now, implied volatility tends to be priced higher than realized volatility. Let me say that one more time, because essentially this one sentence is actually the foundation for my option retirement strategies. When I was working on Wall Street, when I had different mentors, when I was studying options as deeply as I could, and I was in my beginning stages, one thing was true, and that was one data point continued to recur. And that was that implied volatility tends to be higher than realized volatility. Let me explain what that means. Option buyers are not only paying for time, they're also paying for uncertainty. So before earnings, economic reports, or major market events, option prices often become expensive because traders expect large moves. However, in many cases, the actual move ends up being smaller than what was actually priced in. When that happens, option prices fall and sellers benefit from that decline. This is known as implied volatility, and we'll cover it in much more detail later on in this course. When you combine these three advantages, time decay, probability, and volatility, you begin to understand why professional option sellers often approach the market like insurance companies. They know they won't win every trade, but over hundreds of trades, these small statistical edges can compound into consistent long-term results. This is why I believe option selling is one of the best strategies for retirement. Retirement isn't about gambling on the next big winner. It's about creating consistent cash flow while preserving your capital. By using time decay, probability, and disciplined risk management, you're putting the odds in your favor over the long run. Let's dive deeper into putting this knowledge to work. Alright, let's talk about selling put options. I love selling puts as a retirement strategy because you're getting paid to buy stocks that you already once own. Think about that for a second. Imagine you've been watching Nvidia. Maybe it's trading for $200 per share. You've told yourself, I'd love to own the company if it dropped to $180 per share. Well, most investors will simply just place a limit order and they're going to be waiting until 180, or they're just going to say, it is what it is. I have no patience. I don't know if it's going to actually go down. Therefore, I'm just going to be buying it for $200 and change right now where it's trading at. And they're thinking, why would I wait for the stock? Because maybe the stock gets there, maybe it doesn't. Either way, though, while you're waiting, when you sell a put option, you are actually getting paid to wait. That's where selling puts changes absolutely everything. Instead of waiting for free and doing nothing or just buying the stock at the current price, you can actually get paid while you wait. Alrighty, let's go over Nvidia stock as a real example in my portfolio. It's currently trading for $211 per share, and I currently have some Nvidia stock. But let's say that I want to buy Nvidia stock for, something cheaper than what it's trading at today. So what I'm going to do is go to the option chain here. I'm going to go for August 21st, and as you can see, sell put, okay? What I'm going to do is, if I was a stock investor, I have to buy it for $211 per share. That's $21,000. But instead, what I can do is I can just sell a put option. So, for example, I can go down $6 lower. I get a $6 advantage. And I can sell this 205 put option, and the amount of premium that I would get is $6, which actually makes my effective break-even price $199. Wow, this example is so easy, and it's a real live example, and it's really nice because the premium here is exactly $6. So you can really understand here that the strike price is 205. If Nvidia does not go to 205, we're good. We are just getting the $6 premium, and we're just really going to let this option expire. Now, say if the stock goes below 205, we will have to purchase Nvidia for 205 unless we roll the option lower, unless we close the option. At expiration, if it's below 205, we will be getting assigned and we will be buying 100 shares of Nvidia at 205. And we still get our $6 premium regardless. So again, that would make our effective break-even price of $199. So whenever I'm looking to enter stocks, I am selling put options pretty much a majority of the time. I'd rather sell put options than just buy stocks outright. In fact, I have so many sell puts in my current portfolio. I'm going to show you some of the positions that I have. You can see here I have American Airlines 14 sell put. I have some, let's keep going down here. I have a lot of covered calls at the moment. Here I have the Palantir 120, meaning I'd love to own Palantir at 120. I have Google. I have a huge, massive position on Google. In fact, I personally have over $1 million in Google stock personally. And this is a core position within my Discord community. And a lot of people are chasing AI hype stocks, but I've done extremely well with just Google. This position is showing negative $27,000 loss, but I quickly want to show you. I used put options and I actually got into Google stock. You can see here, I'm up $91,800. I'm up 38%. And I got into Google by selling puts. Okay, so I get into my positions selling puts. You can see here I have 1,000 shares, $328,000 in this stock. excuse me, I thought I had a little bit more. What I do have more of is Amazon. I guess Amazon, yeah, I had $671,000 in Amazon. So Google and Amazon, these two stocks make up $1 million worth of my portfolio. And same story with Amazon. I sold puts here to get in. I'm up $96,000. I gave this trade live to my Discord community. It's been some time right now, but all the members that have been with me for at least 6 months, oh man, they're feeling the biceps, they're feeling the triceps. We're making gains. We're doing real good, really good. So I'm just pumped up to show you what this simple strategy could really do for an investor that properly manages their risk, has the proper setup to getting into the right stock, which let's get into right now. Let's talk about stock selection. So before you ever even think about selling a put option, it doesn't matter if you know the right delta, the right, all the right metrics, bid-ask spread, and everything that I showed you so far in this course on tiring. If you choose the wrong stock, forget about it. You're on the wrong boat, right? So if you're taking the boat to the wrong place and your end destination is incorrect, then it doesn't matter how big of a boat you have and how quick your destination is. If you get to the quick destination, but it's the wrong destination, it's no good, right? That's exactly what stock selection is. So what company am I actually willing to own should be the first question that you ask yourself. Not which put option has the highest implied volatility, which one has the juiciest premium, which one is going to fill my pockets with cash today. Because what can fill your pockets with cash today might hurt you tomorrow. And I don't want you to be in that position. That's something that I very much focus on with my one-on-one students. We're not always focused on hitting home runs and getting to the end destination as fast as possible. We're focused on management, on risk management to be specific, so our downsides are not really, exaggerated and not creating too much volatility. And I can't emphasize this enough because it's probably the biggest mistake that I see beginners making all the time. Most investors open their option chain, immediately look at the highest premium. They say, wow, this stock is paying me 6% for the month. Great. Risk? What risk? 6%? Count me in. And that looks amazing, but that's dangerous. What they don't realize is that option is expensive for a reason. High premiums usually mean high risk. There is no free lunch in investing. The market isn't handing out extra money. Money is pretty hard nowadays, and the market does not feel like being generous. I'll tell you that much, okay? The premium is often higher because the stock is more volatile. The company may be weaker fundamentally, although that might not always be the case. So for example, when I show you Palantir sell puts, it doesn't mean that Palantir is a bad company because it has high implied volatility. It just means that there's potentially more volatility that can happen over the next, say, 30 days. So the stock could end up being up and down more volatility. So more volatility isn't always bad, but high volatility typically is bad. Okay, I'll tell you that much because some of the most volatile stocks, they don't just go up in one direction. So at some point, they do come crashing down. In all cases, there is no very volatile stock that only goes in one direction. So when you see a lot of volatility, you want to be very careful. And I'll show you live examples what that looks like. But investors that believe there's a greater chance that shares could decline significantly will pay a higher premium, or they will basically bid up on implied volatility. So forget about the option for a moment. Pretend options don't exist. Imagine someone walked up to you today and said, you must hold on to a stock for 5 years. Okay, I'm bringing up something that Warren Buffett, one of my, I want to say mentors, because I read so many of his books and I watched so many of his lectures. And he says, pretend the stock market's closed for 5 years. Would you still choose this company? That is what your stock selection should look like. Your stock selection should not look like, based off of what YouTubers are saying. There's far too many YouTubers now on this platform, some who have gone through my program and now they're claiming, hey, I'm a professional trader. Hey, my win rate is 90%. Hey, I have banking experience. These guys went through my program and now they're influencers showing you this stock is great and that stock is great. They're using AI and it's very tricky. I want you to be aware of that and be careful. I'm not naming names and I'm not saying everyone is bad. I'm just saying it is very easy to get misinformed, go for the wrong stocks, specifically ones that have a lot of volatility or hype stocks, and you think you're getting information from a credible source, but unfortunately, it's very, very tricky. So here's some of the things that you should look for. You should focus on companies that have a very strong competitive advantage. You should also pay close attention to revenue. Revenue must be going up. That is the whole lifeblood of a business. They must also have very healthy earnings, meaning that earnings trend is trending higher. They're beating earnings. They're at least matching earnings. If they miss earnings one time, that is a very, very bad sign. Also, you need to look at the balance sheet, okay? For me, when I look at a balance sheet, I want to see a lot of cash and I don't want to see a lot of debt. Sometimes debt is okay, but it depends on the situation. And I can't really make a huge blanket statement because different stocks in different sectors, for example, industrial versus technology versus consumer versus healthcare, they're going to look completely different. That's exactly why I do have a Discord community, is because you always want to research a stock first and you want to get a good understanding of the stock before you even run really any option strategies on it. So I want the business to genuinely be growing, have strong management, and on the calls that they have every single quarter where they reveal earnings and guidance, I pay close attention to guidance. I don't just look at earnings because earnings today is already priced in like that. It's priced in like immediately almost. The stock market is very strong and smart. There's a lot of investors trying to make money. It's the most competitive game in the world. So once a company has earnings, they're basically priced into the stock immediately on the next day, and you're not going to be trading after hours. And even after hours, the stock probably changed anyway. So you don't want to just look at what's going on today because that's already priced in. You want to form a strong opinion for what is likely to happen over the next 6 months and 12 months. That's the only way you can get an advantage as a retail investor. There is no other way that you can look at very, very short-term trends, day-to-day stuff, watching the news, listening to YouTubers. None of that is honestly going to work. You need to get behind strong businesses. Think about companies like Nvidia, Amazon, Meta. I like Palantir. I like SoFi, even though SoFi hasn't delivered super well in my retirement portfolio, which is I'm in the same shoes you are. I'm looking to generate income in my retirement, which I'm in right now. And I'm still teaching because this is what I'm passionate about. And when I look at a stock, even say that has not done too well, maybe it's SoFi and Palantir is down a little bit. Hey, heck, even Nvidia's young side base. That doesn't matter because the strategies that we had in our core, which is selling puts, covered calls, and spreads, could do exceptionally well, even if the stock market goes sideways, even if, the stocks are not performing super well. As long as they're not actively crashing by double digits, well, many of these strategies could be managed extremely well. In fact, I see oftentimes in my YouTube comments, hey, you were wrong, the stock is down. Down in what period? And are you just holding stock you bought at the peak? Or are you dollar cost averaging? Are you using options to hedge? Are you protecting your downside with, hedging? Well, none of that's all out the window, right? People are just like, the stock is down. That's very, very far from the truth or the story that actually ends up happening. It's like, hey, you ate cake, you're gaining weight. That's not even close to the full story. That's so little information. You ate cake that day, so you're gaining weight. Maybe you did a lot of steps. Maybe you went to the gym. You're in a calorie deficit. Maybe you only ate cake that day. Even if you ate cake one day, it's not going to do anything if you have a long-term healthy plan of your diet. So you see what I'm saying? Like, you need proper information and you also need to have a long-term plan. Any short-term swings in a stock, it can definitely hurt a portfolio. Don't get me wrong, but it's not really about that. It's all about how you manage long-term. So for example, Nvidia, Amazon, Meta, Palantir, these are businesses that continue investing heavily into artificial intelligence, into cloud computing, into advertising, software, and infrastructure. They have enormous addressable markets and they continue growing despite already being some of the largest companies in the world. In fact, some of the biggest companies in the world are often still great investments because they're still growing and they're market leaders. Now, there's a huge difference between buying a wonderful business that's temporarily down versus buying a weak business that continues to get weaker. So remember, eventually almost every investor selling puts will get assigned. And that is okay. Assignment isn't something to fear. It's something that you should expect. That's why your first priority isn't collecting premium. Your first priority is building a watch list of companies that you actually want to own, that you would be excited owning if you sell a put and it goes into the money and you get assigned. I always tell my students this: invest first, trade second. The option strategy should improve your entry into a great investment, not convince you to buy a bad investment. So once you build a watch list, patience becomes your biggest advantage. You don't have to force trades every single week. You just have to find the stocks that you like, sell puts, because when you sell a put that's out of the money, I go for out of the money puts all the time. My sweet spot is 30 delta. Whenever I sell a 30 delta put option that's out of the money, that already gives me a lower price than what the stock is trading at in today's market, just like I showed you on Nvidia. If Nvidia's at $211 per share, and I sell 205 put, I'm already better off getting it at 205 than 211. Not to mention the premium that I get paid to wait. So simply wait until one of those great companies experience any temporary weakness, or you think that it's fairly valued, which I cover all the time in my Discord community. It's a lot of strategy behind how to find the value of a company. But some of the simple metrics that you can see, even if you're not part of my Discord, is like PE ratio, price to sales ratio. You can use technical analysis to find the moving average. Okay, if you set a moving average that's 50 days, you'll get a good sense of where the stock is trading around, and the market's not dumb, so it's most likely pricing the stock somewhere around fair value. Now, sometimes the market is completely wrong, and that's why it can be very dangerous to only look at one single technical indicator, but you kind of get what I'm saying, right? So I become interested in a company that I find attractive, and I sell a put option at a strike price below the current price, and that is when I'm interested in getting assigned. By the way, here's a quick clip on what assignment risk actually looks like. Here's exactly how to tell if you're at risk of being assigned when selling a put option. So let me illustrate how this works with the chart. Let's say that you're selling a put option 100 days until expiration. The bottom of the chart will represent days, and the left-hand side of the chart will represent delta, which is essentially a scale of how likely you are to get assigned on a scale of 0 to 100. And we're showing right now a line of assignment risk. You see how the assignment risk goes way up as the days are approaching 0. Your safe zone is right here. This green area is from 100 days and beyond. You're very, very safe. Now you see here is your moderate zone. The moderate zone really starts to happen in the final month, especially in the final 2 weeks. See, if delta is high, there's still a lot of time left, it doesn't really matter. Your assignment risk is still very low. However, if delta is 50 or higher, in that range, it starts to become moderate, especially in the last 2 weeks. Now you see here the risk zone. The risk zone where delta is say 60 to 100, that's where your risk starts to really go up. So for example, if you have an 80 delta option and you have sold a put and it's 80 delta and there's only 3 days left, you are definitely in the risk zone and your chances of getting assigned might be 50% or more. Number 2, assignment risk matters because selling a put option means that you are agreeing to buy 100 shares at your strike price if you were assigned. That means that you have to have cash on hand, and if assignment happens, your cash will be deployed and you will buy 100 shares. Now, early assignment happens when someone wants to force you to take shares before expiration. This can be pretty dangerous if you don't have the cash available or you're simply not prepared to take assignment, or for whatever reason, you don't want to take assignment. A higher delta means there's higher assignment risk. As you saw in the chart that I showed you, the higher delta is, the higher chances of assignment risk. If there's a lot of time left, then you're okay, right? You have a lot of time. But as the option approaches expiration, there's not that much time left, and a high delta, that's when your chances of early assignment increase. Delta is a very important factor, and a lower delta actually means that you have a low chance of getting assigned, even if it's slightly above 50, even if it's in the money and there's some time left. So to summarize the risk zone before we get into number 3 on how to manage the risk is green, you're safe, and that's lots of time left, and or low delta. Yellow is your caution area. That's when your delta is medium, maybe it's over 60, maybe it's 70, and there's a medium amount of time left, say 2 weeks or 3 weeks. It's very rare for assignment to actually happen in the yellow zone. I just put as caution because you're not that far away from the red zone. Now the red zone is a danger zone. That's when you have high delta. High delta is 75 plus, so 85 delta would be high delta, and that's when you don't have that much time left. For example, you have 2 weeks left and you have an 80 delta, that's when you're really getting into the red zone. If you need a reminder of the green zone, the yellow zone, or the red zone, then feel free to rewind this video and watch the chart that I drew and the time and really understand that chart and go back to it as needed. All right, now let's talk about choosing the right strike price. I showed you an example on Nvidia 205, but hey, what's the right strike price? Why don't I go lower? Why don't I go higher? Now that you've selected a company that you genuinely are happy owning, the next decision really comes down to choosing the right strike price. This is where investing becomes much more strategic because the strike determines 3 very important things: how much premium you're going to collect, the probability of getting assigned, that is through delta, and the price that you'll be potentially purchasing the stock at. Most beginners think the goal is simply collect premium, get high premium, and maybe sometimes get assigned. But that's a little bit backwards. The goal is buying a great company at a great price while collecting fair compensation for waiting. Personally, I like using delta as a starting point. Without diving too deeply into the math, delta gives us an approximation or probability that an option finishes in the money by expiration. A 20 delta put roughly implies about an 80% chance of expiring worthless. It isn't perfect, but is an excellent guide. It is based off of really deep mathematics called the Black-Scholes model, which is pretty useless for us to go into. It's not that important, but it's based off of a really strong mathematical number. So delta is honestly the most important figure, and it's one of the Greeks that I look at the most. That's why I generally sell put options somewhere between a 25 and 30 delta, because on a long-term curve, 25 to 30 delta has a good mix of decent premium income while also having relatively low risk. Let me show you what that looks like. All right, let's jump into the portfolio again, and I'm going to look at Amazon for now. I'm going to show you several different options. So let's go for August 21st, or hey, September. This video will take some time to edit. Let's just go for September. So let's go to sell put option, right? So if I go for something close to the money here, like 235, you can see the delta is 0.35. So actually, there seems to be skew that Amazon is not likely to fall, because the delta here I would think would be higher since it's so close to the current price of Amazon. Yet it's not that high. It's only 35 delta, which means there's only 35% chance of Amazon being at 235 or lower on September 18 expiration. Okay, we can kind of see that clearly here. And one thing I'll point out is the IV is about 39. Okay, that's not high, it's not low, it's somewhere in between. And I want you to pay close attention to the bid and ask here, which is roughly $10. Okay, so $10. I'm going to put this math up on the screen. I just want you to understand the yield that this option has at a 35 delta, and then we're going to show you different deltas, and then we're also going to compare to different stocks step by step. Okay, no worries. So $10 is the premium, and the capital requirement here is going to be 235. So here's the math on the screen, and I'm going to guess that the math is about 4.5%. I'm gonna just guess based off of some rough math that I'm gonna do myself. So 4.5%. Okay. Now, let's go a little bit lower. Okay, let's see what happens when we go a lot lower and the chance of this option going to the money is decreased. Okay, so here the delta is 14. Okay, a 14 delta is a lot lower, obviously, because only a 14% chance of Amazon being 210 or lower. And guess what? Look at the premium. The premium is $3.20, which is essentially like 1/3 of the previous premium. So let's put the math up on the screen again. Okay, what is $3? And your collateral requirement here is 210. So now the yield before was 4.5. I'm going to guess this is about a 1.4% yield. So which one's more? Of course, the one that had a higher delta, which was roughly 4.5, is much bigger. I'm going to draw on the screen right now, is much bigger than this current one, which has a smaller delta, which is this yield right here, which is, I'm going to guess 1.4%. So 4.5 is more than 1.4. And it's significantly more. And the reason why it's more is because of the higher risk. And higher risk means that investors should get compensated more money. Okay. And the bid-ask spread here is also very good. Same expiration. The IV is about the same. It's not 39, it's 40, but 39, 40, it's very, very close. Okay. All right. Let's go into a different stock because I want you to see a more high implied volatility stock. I want to find one of the AI stocks that I have in my portfolio. NBIS. Okay. Lots of volatility in this stock. You can see over 1 year, it's crazy. This is the biggest position that Leo called Ashenbrenner has, which is a few videos I made on him as an investor. But this is a high quality company, I would say. It's up a lot. It's, core to the AI story here. And I don't have much shares, but through trade options, I want you to see what selling a put option looks like on an high volatility stock. Let's go to September 18 here when you get a sell put. Now let's go find, and you'll notice right away that if I go for something that's really close to the money, the delta here is 0.38, which is very, very similar to Amazon. But look at that IV. That IV is 143. That is a very high implied volatility. That's as high as it basically gets, as I've seen. Very risky, lots of movement, and the option market is predicting that NBIS could potentially crash. Maybe it'll go up, but it's definitely going to experience lots of volatility. And you will see here, I'm going to put up the math on screen again, that roughly this is $50 worth of premium if you sell a put option. And the amount of collateral that you would have to have would be 220. And I could do the math right here that this is basically 23% yield. This is a 23% yield roughly. Wow. Delta of 38, which is not even that high. But the yield here is astronomical. And why is it so astronomical? It's because the IV. IV is so high. And investors demand that they get paid for the dangerous risk that they're taking upon themselves when they get into this stock. Okay, let's go a little bit lower here. And you could see if I go much lower, which is like, what, $50 lower? This is roughly $50 lower right here at the 180 put. Still very high implied volatility, 146. And you can see here that essentially the premium is roughly $28. I'm going to take $28 and divide that by 180, and that's somewhere around 15% is going to be my guess. But I'm ballparking, but the real math's on the screen. Crazy, insane. 15%, it's like $50 different from the current stock price. It's very hard to resist only doing this because this could look so attractive, especially to a beginner investor. And it is very attractive. If you do it right, I'm telling you, selling puts is not that boring as you might think. I'm starting off slow in this course because if you're not part of coaching, I want to be as safe and conservative as possible with my public content. But as you can see here, this is the type of stuff that I'm personally doing in my community. I'm going for higher implied volatility, but I'm picking and choosing my spots very correctly because, again, I want to say this. Option trading is very risky. I'm not a financial advisor, and if you don't do this correctly, you can lose a ton of money, okay? So when I pull up a high implied volatility stock, there is opportunity there, but you got to know what you're doing. One tip that I have for you, if you're going to do AI stocks or something with very high implied volatility, take your delta a little bit lower. You can take the delta down from the sweet spot, which I talk about 25 to 30 delta. Go a little bit lower. It's okay to go for lower delta. In fact, I would say that it's better because a lower delta gives you less chance of assignment. So if you're going to trade risky stocks without Uncle Henry right here to guide you, that's kind of my biggest tip is just go for a lower delta so you experience lower volatility ideally. But honestly, delta is not the only part of my decision-making process. I'm also looking at support levels, and I'm trying to understand the value of the stock fundamentally, which takes a whole lot of time, and analysts on Wall Street spend weeks and weeks coming up with price targets, which, by the way, oftentimes are even incorrect. So another tip is try to go for bigger stocks if you're going to do the research yourself. It's much better just to go for the blue chip stocks. So for me, Max 7 stocks are great, although they don't always have the highest volatility. They have very decent volatility. So I think it's a really good trade-off for someone that is kind of DIY investor. Just never let a few extra dollars of premium convince you to buy a company at a price that you're not comfortable really owning that company to begin with, okay? Now, in terms of expiration, let's discuss expiration. I showed you, a couple options so far on September 18, and that's because I'm making this course and September 18 is roughly 6 weeks out, and by the time I edit this course, it might take me 2 weeks just to edit and make it all beautiful and nice so it, is worth your time watching. But that's not the important point. What you should understand is if you want to go for weekly income or monthly income, I think in both scenarios, that's completely fine. Some people like the weekly aspect because, they like to withdraw a little bit of money and then use that for living expenses versus some other investors, they're very comfortable just, not touching their money. Maybe they're still working. They're not, retired yet. They have income that works. So what they're looking to do is just reinvest the money back in their portfolio and, let their portfolio compound. And that's personally, what I'm doing most of the time. I'm just letting my portfolio compound, although I'm taking out 75, 80% of the income out of my portfolio because I am kind of in that retirement stage myself. So what you want to do is just find the best mix. If you want to go for weekly income, that's fine. But ideally, there's less trade management to do when you're on a monthly basis. So whenever you're selling options on a 1 month out basis, then just kind of sell put options. And really, you sit back and wait for either assignment or for that option to expire out of the money. So I generally prefer about 30 days. Sometimes I go 30 to 45 days until expiration. There's really several reasons for it. So first of all, time decay and theta decay really begins accelerating as expiration approaches, which benefits option sellers a lot, right? Now, second, premiums are usually still very attractive and juicy to justify a trade that's 30 days out. The premium could be, very large, of course. And then finally, I'm not really constantly trying to manage positions after a few days. I don't want to go like day to day just because, yes, I trade, but my primary kind of passion in life is coaching. And oftentimes on my phone, I'm messaging, my clients, my students back and forth. Hey, this position looks good. Hey, I see this opportunity in this stock, doing lots of research, and I don't always want to open up my portfolio and spend my time and waste my time managing trades because I'm already at my retirement numbers. So for me now, it's all about giving it forward, teaching other people, doing what I enjoy doing with my time, just communicating with other people, helping other people, and trade management is not something I want to spend my time on. I don't want to be on the computer looking at the trade specifically. So, that's why I don't like weekly trading, but I think that some people, they like that trade management process. So see what works for you, or, we can build something together. We can customize a plan for you together if you like. But I like monthly personally. And whenever I work with busy professionals, engineers, doctors, business owners, I'm like, hey, let's just stick to the monthly plan. Occasionally, I will extend 45 to 60 days out if implied volatility is elevated or if the premiums are significantly better. This often happens after large market corrections when fear has increased throughout the market. Longer expirations can absolutely make sense, and oftentimes when I'm working with bigger portfolios, I'm using longer expirations. In fact, sometimes I even do something I won't even, it's kind of considered risky, but I do it in a unique way. I even use margin. So sometimes I'll sell puts personally on margin, and I'll do so with, anyways, I won't mention too much that it's risky, so I'm going to kind of leave that aside. But anyways, whenever I see longer expirations, that's fine as well. There are situations when you might want to use that. And honestly, it really comes down to really comparing the annual return that you get and the risk that you're taking. So finance and investing is all about risk and return. So if I'm collecting a certain yield and I know the risk that I'm taking, which is implied volatility, which is given to us, and we oftentimes get the premium as well, then we know our risk and return. We can also look at the amount of capital or collateral that we're tying up, and that gets us to the fundamental equation that we're looking for, which is what amount are we making for what amount of risk and time that we're taking on this. I go a lot more into detail with a calculator in my community, so if you want to know the exact math, you're welcome to schedule a free call to discuss what my monthly premium option selling calculator looks like and how I decide which trade I'm actually making. It's a free call and you can talk to a coach and understand what that calculator looks like, how I analyze the trades that I'm making. And if you're interested in Discord, you can also have a discussion about the Discord community. To summarize, the right strike price for beginners that I mainly use is based off of delta and support levels as well as fundamental analysis. Never trade meme companies, never chase high implied volatility stocks just because they have attractive premiums or companies with deteriorating fundamentals. Focus on trade management, and as a retirement strategy, selling puts is as straight and forward as easy of a process as it gets. I love selling covered calls as an income generating strategy. I have 3 stocks that I'm going to be showing you that I'm selling covered calls on right now. It's going to be a very educational part of the course for you, and I'm going to be discussing 3 different covered calls using 3 different volatility levels. Yeah, low volatility, medium volatility, and high volatility, so you can understand the difference between these 3 levels of volatility. Because implied volatility, it actually changes everything. A low volatility stock, you're not going to be trading it the same way as you would with a high volatility stock. And then we're going to talk about the medium volatility, which for me, we're going to be using Meta as an example. It's going to be very interesting because the way that I manage a low volatility strategy is more aggressively. Because it's low volatility, I'm able to be more aggressive with it. But with a higher implied volatility stock, I want to be a little bit more safe and conservative because volatility is there for a reason, as we've already covered in this course. So let's jump into my portfolio. So the first stock that we're going to cover is going to be a low implied volatility stock. We're going to be using McDonald's. Here's a quick reason why I like McDonald's. So of course, McDonald's owns all the real estate of all the stores that they have. So the food business is only kind of part of it, but really the wealth that they've generated is from owning the actual real estate under all of the franchises that they are managing, right? So McDonald's decided that it's not worth really helping anyone anymore, and they are following some of the industry research, which is Starbucks has found the perfect mix between digital and human ordering, and you can use the company's app to place your complicated order and know it will be made exactly the way you want, and people who don't want to use the app can stand in line drive through to order from an actual human. Now McDonald's has embraced a lot of technology but at the expense of people. Now, hey, good or bad, I'm just showing you some of the ways that I look at a company to kind of make a decision. Of course, there's a lot more to it, like technical analysis and fundamental analysis, which I'm going to show you, but it all starts off with understanding the business. Okay, you want to read part of the annual report, you want to understand what the company does, what the business does. McDonald's is pretty straightforward, and this is a low implied volatility stock, and that's one of the reasons why I want to do a covered call on it. It's because I'll show you it's near the 52-week low. I just found this article interesting because I just opened up Yahoo Finance to open up McDonald's, and this was really cool. So McDonald's has made digital ordering its priority. That's really important, by the way, because digital orders are a higher profit margin than in person, because obviously you need employees to do in person. So while McDonald's still has manned cashiers, that's no longer the common experience. Instead, you walk in and can either go to the register and hope someone shows up, order via the kiosk, or through the app. So they are encouraging heavily the app. Okay. Anyways, let's go into McDonald's. I want to go over some technical analysis here. Over the last 1 month, McDonald's is pretty flat. It's very, very flat. Over the last 6 months, the stock is down pretty significantly. That's what I actually like to see when I'm doing a covered call, because a covered call is a moderately bullish strategy. Okay, you're going to lose money if the stock goes down. If the stock goes lower, you're going to be losing money. That's why when you do a covered call, you want to find a stock that's not at a 52-week high. Ideally, it has sold off and it's looking like a good value, because again, bullish strategy, you want the stock to ideally go up. But even if it doesn't go up, a covered call will still do very well because you collect premium, and if all else equal and the stock goes sideways, that premium is yours to keep regardless. So, I want to do a covered call on a moderately bullish stock. Now, why not a really, really bullish stock? Well, the reason is because there's a trade-off, okay? There's a trade-off between generating income, okay, as I sell a covered call and show you, versus if a stock ends up skyrocketing, well, you don't get all the upside. So there's a trade-off between income generation versus limiting upside, because with the covered call, you have a ceiling. You have a ceiling, you're capped at the strike price that you sell a covered call at, okay? So let's kind of construct and go back and forth between technical analysis and actually constructing the trade. So let me go here, MCD, and I'm going to open up McDonald's, and I'm going to trade an option on it. And you can see here how it's a little bit up pre-market. I actually already have McDonald's. I have 100 shares, and I bought it at 266. And I told my Discord community when I got into this trade. And you can see I also have 2 call options. So I am betting for January 2027, and we'll talk about buying call options, specifically leap options, a little bit later in this course. But I am pretty bullish on McDonald's. So let's go into trade McDonald's options, and let's go back to the chart right here. I'm going to actually click into the chart, and I want to show you kind of on a longer grand scheme of things where McDonald's has been and kind of what it's looking like. So you can see here what a tremendous sell-off over the last 6 months. McDonald's, was trading for $340 per share. So there was a very, high point for McDonald's. And then you can see here how it has just taken really the steps down. It's taken the steps lower here. And you can see here, this red line is the moving average. So the moving average has gone down significantly with the stock, because the moving average here is a 50-day moving average. So it calculates the average price over the last 50 days. And this has come down significantly to 275. And we can see some stabilization on McDonald's. You can see here on the rough technical analysis, if we were to draw a line here, let me draw a line. Yep, I already have the line here. So if I go from here, this point 264, to, here 270, we have a nice support level. We can see visually that there is stability now at this price level. We can also see that the RSI here has traded, fairly low. It has gone to, kind of the mid 30s here, again in the mid 30s, and has kind of stabilized here. So overall, my whole kind of conclusion of the technical analysis is lots of stability. This stock is not in a free fall anymore. It has, come down to 264, and it has bounced already several times, 3 times to be exact, right? Now, this is kind of like the technical look. Let me also add another indicator here. So I'm going to add indicator. I'm going to go to the Bollinger Band. The Bollinger Band is something that I have been teaching for an extremely long amount of time, 6 years before anyone else was even on YouTube. Even some of the bigger channels that have outgrown me. Maybe I'm not the best marketer and I kind of stick to my own wheelhouse here, but I guess I'm trying to flex that I was here teaching this first, and now I'm upset that everyone else has kind of stepped in and started teaching Bollinger Band. But that's not the point. The whole point is that you understand the Bollinger Band and that it works for you, and that the end investor sees success. I think that's the most important part, and that's why the Bollinger Band has become so popular, is because it really shows you kind of a band of what is possible within the realm of possibility and what's likely to happen. It's based on statistics. So basically, this Bollinger Band, which is 2 standard deviation, stands for, if you look at a simple bell curve, okay, in statistics, and I won't go too deep, I'll keep this as simple as possible, but in statistics, there's the bell curve. I'm going to draw it right here. This is what the bell curve looks like. The average, or the middle of the bell curve, would be 0 standard deviations. Exactly what is likely to happen happens. So if you pick a random human from the United States and their income is 70,000, well, that is about the average of United States income, right? So if you grab a random person at 70,000, well, that would be a 0 standard deviation. That would be exactly what you would assume. Okay, that would be the average. Now, if you pick the person, at a random, and that person had $140,000, per year income, that's a bit above average. And the standard deviation would be, say 2 standard deviations away. That says that this is unlikely. And the 2 standard deviations specifically captures in 95% of the data, meaning $140,000. If it's pretty rare, it's going to be on the right-hand tail of the bell curve. And if you pick another random person, they make $10,000 per year. Well, that's also pretty rare, and that's unexpected. So that person is going to be on the left tail of an unusual income. So the bell curve explains what's normal. You can also think about it simply as human height. So, if you're a 5'10" man, your son's going to be about 5'10". If your son is 6'1", well, that would be 1 standard deviation away, 3 inches, taller would be, 1 standard deviation higher than usual. And if he was 6'4", well, that would be 2 standard deviations higher than usual. So the standard deviation just tries to explain how usual something is in relation to average and variance within a probability. Okay. So here, this standard deviation is 2, which means that it captures 95% of the data, right? So essentially here, McDonald's stock would trade as low as $259 or as high as $282 in a 2 standard deviation case. If I were to do 3 standard deviations, this would expand and there would be more variance. variance, meaning that, McDonald's could be higher than 282, maybe 290, or lower, maybe 250 or lower than that, right? I use 2 standard deviations because it captures in 95%, and I'm already happy with that. That's typically, the probability that I want to go for. But anyways, you can see here that the stock is likely to trade within this range, and the moving average is 275. So again, stock has found a lot of stability. It's pretty tight within the Bollinger Band. It's actually at the middle of the Bollinger Band, which is good. So I expect the stock to kind of recover and go towards the top of the Bollinger Band, specifically because I believe McDonald's is undervalued. Now that's technical analysis. Okay, that's a simple technical analysis. I spend 30 minutes plus sometimes on technical analysis during my live calls on my Monday or Wednesday session. I'll go way deeper than this. So if you want more of the advanced stuff, you actually want to become more of a stock picker and use technical analysis to your advantage, highly recommend that you become part of the community. Let's move over into the fundamental analysis though. The fundamental analysis I'll show you simply is the PE ratio. That's one of the most important fundamental kind of ratios here that you want to look for, is simply price, to earnings. What does that ratio look like? How much are you paying for the company's earnings? So technically, this PE ratio could be reversed. So for every $1 that you make per year from the company, you're paying $21 for it. So of course, you want a lower PE ratio. A PE ratio of 10 means that you get $1 and you're paying 10. Think about it similar to like real estate. So if you have a $100,000 property, okay, and you collect $10,000 per year, that's a 10 PE ratio. Now, if you still make that $10,000 of rent per year, but that property costs $200,000, well, that's a 20 PE ratio, right? Anyways, the long term, and I can actually show you Shiller PE ratio. This is kind of interesting here. There's a guy named Bob Shiller, who's a very famous Yale economist. He has a Shiller PE ratio, okay? He shows you historically on an adjusted basis what is the PE ratio with inflation included and everything like that. You can see here price earnings ratio based on average inflation adjusted earnings from the previous 10 years, known as a cyclically adjusted PE ratio or CAPE ratio. So here we can see that actually the PE ratio is actually pretty high. This would indicate that you don't want to say it's a bubble, but this is actually pretty high. 40 here is higher than average. So here we would want to be very careful in general in the stock market right now. But this is a Shiller PE ratio. We can look at the S&P 500 PE ratio, and this will give us a different story here. Well, the website wasn't working, so I had to pick a different website here. But you can see the PE ratio for the S&P 500 here in general, and it's hovering here in the high 20s. So you can see here in 2008 that it went extremely high, right? You can see how high it really went. And then here now is in the higher 20s. Now going back to McDonald's, we see the PE ratio of 21. This is actually lower than the current PE ratio. This means that, on a fundamental level, that this stock is cheaper than the S&P 500. Now, cheap doesn't always mean that it's better, because sometimes a PE ratio can just be lower simply because the company is growing less. And we'll see a good comparison with the second and third covered call that I'm going to show in this video. But here, PE ratio 21, okay, cheap enough. Let's go ahead and actually construct the covered call. Let's go to sell call option here. So first of all, to do a covered call, you need to have 100 shares, okay? Like covered calls. If you sell a call without having the shares, well, you're doing a naked covered call, and most likely your broker won't even allow for that, because unless you have margin enabled in level 3 trading and you have a bigger portfolio, you're probably not even going to be able to sell naked calls anyways, and that's a super risky strategy. So I just want to get that out of the way. A covered call is when you have 100 shares of the stock, okay? So look, sell call. I'm just going to go for September expiration here, okay? If I go back to the chart, okay, we go to the 6 months here, we can see that really $300 level is kind of the next point of resistance for McDonald's. We can see has not really gone to $300 per share since April 2026. Okay, so since April, stock has not been to $300 per share. So that's kind of a level where I would feel really comfortable. Now, if I try to sell that level, because it's a low implied volatility stock, I'm really not going to get much for it. Okay, you can see here at the $300 level has a premium of $1.95. Now, is that good? I would say not so much. The percentage here is pretty low, right? So like a 1% premium would be $3. So this is not even 1%. Not that attractive, okay? So if I go back here to McDonald's, we can see here kind of a lower point where there seems to be a mini resistance. It's around 287, 288, okay? So I'm gonna go back here, and now what I'm going to do is I'm going to adjust my strike price significantly based off of the more recent resistance level. So 280, okay, I said 288, but why 280? Well, here, 280, if you factor in the premium of 640, which is much more attractive, this is over 2% in terms of premium that I'm collecting, much more attractive, still actually gives me great upside. Because if I buy the stock currently for $273 per share and I sell it $280, well, I got $6-7 worth of upside before I hit into the money. You can see here how this is showing a loss, right? This is showing a, how this position goes down. But this is not factoring in 100 shares, okay? Robinhood here just showing what a short call looks like without the shares, okay? With the shares is going to be very different. All right, I'm going to demonstrate why it's very different using paint. I'm not a professional artist, so it won't be perfect here, but it's going to be super awesome to look at. So I'm going to kind of draw a chart here, and I am using keypad here. All right, so here is the chart. We'll just do McDonald's stock. I'm going to do the same example. We're going to look at the 280 here because I want you to understand what a covered call actually looks like and kind of the different parts of the covered call that you might need to manage. Okay, so essentially if the stock is at 273, okay, this will be the price. Okay, so we'll call this 273. I didn't really give myself enough room here on the downside on the bottom of the chart, but super small 273. Okay, and then here this goes on to like, let's say 350. Okay, so this is 350 here, and then I'm going to show you what happens to the stock. So we're right here, right? This is where we are right now. Okay, so if we go up here, and this is 280 by the way, so this is the level at which we sell the strike price, right? Well, first of all, we know that our limit here is 280. We can't make any more. But if we collect $6, okay, we make $6, then our maximum is 280 plus 6. Be somewhere over here, okay? Would be somewhere over here, and this would be a gain. Okay, here we would have a gain of 640. But this would not only be 640 of premium, we also have this rise right here, okay? We have this rise, and at 280, we're done. We are done. This is how the chart looks like, okay? You go up, and you make money up until 280, and then you're done. But your gain when it hits 280 is not $7, although this is a $7 gain, because you also collected premium, right? So you have $7 plus 6, so you really have $13 gain right here. Okay, so this is a $13 gain, or essentially because each option is 100 shares, you have $1,300 in this example that you would be up on, okay? Would be up on 1,300. All right, so a regular stock investor, by the way, who does not have a covered call would have something very different. It would look more like this, okay? A stockholder would look more like this. So this is S, the stockholder, and this is C, the covered call holder. S is going up indefinitely because it's a stock and you don't have a ceiling. So you can go up, as much as really needed because it's just a stock. If the stock continues to rise, you continue to rise with the stock if you're a stockholder. But a covered call seller has a limit. You can't make any more than the ceiling of the strike price that you sold the covered call at. So if you sold the covered call at 280, donezo. 280, that's it. But factor in the premium. In this right here, okay, I want to show you, this green that I'm drawing right here is the benefit or the better off situation that you have. Fun to draw this, but you are better off than the stock investor at these levels. So between 273 and 280, which keep in mind, this is a low implied volatility stock, meaning that McDonald's I'm bullish on, and it's not really going to have that much volatility. So the likelihood of it being in this range, going back to Bollinger Band, is like 95%. Okay, so 95% of the time, you're going to be better off than the stockholder. Now, the stockholder here, they start to profit more than the covered calls. So this red right here is what you will miss out on if the stock continues to rise. And I'm going to write here FOMO, or fear of missing out, because this is where a covered call investor will be sad. Okay, you're going to be a little bit sad here when I draw a little bit of frown. But just because you're sad or you're feeling FOMO doesn't mean this was a bad trade. It just means that the realized volatility was higher than the, what was implied. An unusual scenario happened and the stock ended up rising, and you're still going to be at your max kind of profit here of 1,300. Okay. Now, on the downside, let's talk about the risks and the dangers. Okay. This is a bullish strategy and it's very similar to just owning stock. So if the, stock goes down, you will lose money. Okay. However, what's actually nice is because at 273, if you buy it for 273, you'll have a cushion. Okay, you're not going to lose money right away because your average cost is actually, have to put in $6 into it. Your actual break even will be here, will be right here. It'll be 273 minus 6, it'll be 267. That'll be your average break even cost. So whereas a stockholder, if it goes down, he starts losing money immediately. He starts going down immediately, which I had more room here. I wish I can scroll this higher. Yes. Beautiful. So a stockholder will start to lose money like this immediately, right? Whereas you will still actually have gains here. You'll actually still have this portion of a gain until you reach the 267. So here, I'm going to just draw this as a gain, this portion. This is your cushion. Okay, let's just draw a little bit wider like this. Okay, and then you will start to lose. So actually very, very similar to a stockholder, but you have this extra cushion. Whatever you collected here will cushion you from downside, which is what I really like about covered calls, because it cushions you. It gives you cushion on the downside, and it gives you a kind of a high probability of getting that premium income and hanging on to that income in this range, right? And then you have FOMO on the upside. All right, so going back into the stock, McDonald's, let's just wrap up this example and go to the next one. I think you get it at this point. Let's go on to the next stock, which is medium volatility. This is going to be on Meta stock. Now, I like Meta a lot. I think advertising is super strong. In general, Meta's advertising business will continue to improve. And this company also has gone down a good amount. Now, they do report earnings on July 29th, and I'm making this on July 28th. So I'm going to risk it in this video to show you a covered call. And, you know, when you're watching this, you can check out the Meta price and see, hey, you know, was Henry right? And what actually ended up happening? It's actually going to be very, very interesting. The medium volatility stock is actually kind of my favorite range because it's not crazy high implied volatility where there's a lot of risk and, you know, the portfolio is bouncing up and down a lot. Medium volatility is my kind of favorite range. It's a balance of premium with capital appreciation. The delta that I typically go for on medium is 30 delta, whereas with, you know, the lower implied volatility on McDonald's, we'll go back to McDonald's for a second, the delta here was 40. Okay, and I didn't even know that. I just instinctively chose this, and it's 40, which is exactly kind of where my low implied volatility stocks are when I sell covered calls. For Meta, I want to go for 30. So let's open up Meta right now, and I'm going to show you 30. 30 is going to be a better mix just because 40 delta means that there's a higher chance of the option expiring in the money. Less capital appreciation is more income focused. And you need more income when the implied volatility is low because, well, you know, the stock's not going to have any premium whenever you go for more out of the money options. Here, though, with Meta, and I have a pretty significant size position on Meta, $359,000. I'm a little bit down on Meta in general. It's not performed super well. But hey, my portfolio has actually done extremely well despite all the volatility in the market and also withdrawing money from my portfolio. So I have done, I would say, extremely well comparing myself to some of the other YouTube channels that I, you know, watch and I see what other coaches are doing, of course. My portfolio has been one of the most stable during all the volatile times. So very proud of that. That's because my focus is on risk management and covered calls as a strategy really shields against, you know, all the downside risk because it also has cushion. So whenever the market goes down 7-8% or there's like a mini crash and people are, you know, just struggling super hard and they're down 10% because they're in risky stocks, I might only be down like 3-4%. So relatively very good. And part of that I attribute to the strategy right here. So Meta, I'm going to go for sell call. Let's go for September expiration. I'm going to show you how I open this position up. Okay, here we go. Meta. And I'm going to look for, let's expand this. No, that's too high of a delta. 650. Okay, that's pretty much price. 660, let's see. Good. 31 delta. Okay, that's good. All right, so let's go into the technical analysis. Let's go to 1 month here. 7% up. Here we can already see here without me even having to scroll too much higher. We already see a nice resistance here, 670, 680, perfectly kind of confirming the resistance point. You can see here again from April, resistance at 680. So clear trend 680. And wow, the P ratio here is 21. Wow, it's the same thing as McDonald's. So P ratio is the same, but this is more medium implied volatility. And I didn't show you the implied volatility on McDonald's. You can scroll back. You know, whatever I showed there, I believe that it was probably under 30. You know, we can just click back here and see what the McDonald's was because I am curious. I think it was probably around 30. Actually, we have to go to September here. Sorry about that. Put a sell call. But 280 here, 24 implied volatility. See what I mean? It's very low. Yeah, that's low implied volatility. Now going back to Meta, it's going to be medium volatility. So let's go to September here. Let's go back up to 670. Sorry, I'm bouncing around. But I wanted to show you the 24. And here Meta is almost doubled. So it's at 46, 45, 46. Okay, the delta is much lower here at now it's 28, so I guess I was looking at the 660. It doesn't really matter. What you want to know is you just want upside, and whenever you sell a covered call, whether I go for 660 or 665 or 670, this entire range is doing the same thing. Okay, it's doing the same thing. What it's doing is it's giving me capital appreciation, and because Meta is under $600 per share, I have all this room for upside up until, again, the strike price. So 660, 670, fine, so be it. Now, I do actually want to go for 650. The reason is because we have earnings. When you have earnings, you have so much premium because implied volatility is so elevated. You don't have to give yourself as much upside because the premium is already so juicy that it basically, when you factor in the strike price plus the premium, our break even here is 670. That's a lot. 670 is a lot. Considering the stock's under 600 and you get 670, this option expires in 52 days. I'm happy if I can put up, you know, in this trade example, 60K, and then I'm getting 67K at my exit point. Because that's essentially what your exit point would be, is the strike price plus the premium, which is 671. So in this trade example, if you buy 100 shares for, $59,800, and then if Meta reaches 650, once you factor in the premium, your exit price is effectively 671. Okay, so you can do kind of the math there. And this is so attractive because the implied volatility is higher, and I'm dialing in the delta a little bit lower, okay? A little bit lower than, 30, but higher than 40, so higher than McDonald's. McDonald's is a really tight, small difference. It's because the implied volatility is low. With medium volatility, I want to give it a little bit more room to breathe because post earnings, hey, Meta could be a $650 stock. Now, I don't know what's going to happen with earnings. I think there's going to be a lot of volatility, but I'm going to place a bet. I'm comfortable placing a bet that Meta probably won't, move up or down more than like $35. Okay. So this $20 right here, if Meta goes up by $35, it'll be at $635. I'm still out of the money on my option. I've collected all that upside and I still have all the premium here collected. Great. Now, if it falls down, I'm getting a cushion of $20. Okay. So that's kind of the play here that I'm looking at with Meta. Now, next stock is going to be Palantir. Palantir I've covered significantly on the channel. I've had it since IPO, sub $20 per share. And Palantir is really interesting because it actually has a very, very sideways story. Just the last 6 months, it hasn't done too much. It's down 20%. But again, for a super volatile stock, 20% down, that's pretty normal for high volatility. Okay. So let's go ahead and open up Palantir right now. Okay, you can see that Palantir also has earnings in 5 days. And I want to open up into the options. You can see I'm actually up a lot on Palantir. So to trade Palantir options, I'm going to go sell call. And I can even show, let's just stick to the same date so it can be standardized. You can understand the difference in volatility. So let's go for 135 here. You can see that the implied volatility is 61. So now it is, 50% more riskier, higher implied volatility than Meta. And you can see just how much that makes a difference on the premium. Okay, so an option that's $10 above the current price, that's 10 full dollars basically of upside, still has 10 more dollars of premium. So high implied volatility stocks have higher premium, and it just honestly has higher and more aggressive risk for getting assigned. You can see the delta is 0.51. It's a high delta, yet this is a pretty far out of the money option. And the reason why delta is so high here is because there's so much uncertainty in the option. And that's why if I was to sell a covered call, you have two choices with high implied volatility. You have a lot of flexibility here. You can either go for a pure income approach. You can sell, very close to the money and give up your upside, but then you have huge kind of premium here. Or if you don't want to feel the FOMO, you can go super high out of the money, like 150. You can decrease the delta. You can continue to decrease the delta even to 165, 20 delta. And the premium here is still better than McDonald's, yet this option is literally very, very far from the current stock price. It's very far out of the money, low delta. It's still more attractive than McDonald's. And I'm not, talking badly about McDonald's. I like all three of these positions. I think you should be mixing up high volatility stocks, lower volatility stocks, and medium volatility stocks, exactly as I showed you in this video. Now, one of the mistakes that you can make is just chasing premium alone, so please don't do that. Another mistake that you can make is really mishandling assignment and, not paying attention to, taxable events, for example, or how dividends impact the covered calls. And that's some of the more advanced stuff that I cover in my community.
Now, let's get into the part of this course where we talk about the complete wheel overview. The wheel strategy is a systemic approach to generating income from stocks using options. It's called the wheel because there's a continuous cycle that keeps rolling, okay? You start off by selling a put option until you're assigned, then sell a call option, and then until your shares are again assigned and called away, and you just start the wheel all over again. This system and process has generated me 7 figures. It has generated my students 7 figures, or actually 8 and 9 figures if we take all my collective students.
So to do the wheel strategy, you need to know what a covered call is. You need to know what a cash secured put is, which I covered earlier in this course. So go back to that if you don't fully understand them. The wheel strategy involves a covered call and a cash secured put at different times. To start off the wheel strategy, all you want to do is sell a put option. Once you get assigned, you start selling covered calls to generate income on the position that you got assigned. The wheel strategy is my very favorite strategy, especially as you scale your portfolio. So first you start by selling a cash secured put. A cash secured put means that you have the cash that if that put were to get assigned, then you have the cash to purchase that put option if you do get assigned. So say that you sell a put option at the $100 strike of a different stock, let's say it's Apple. Then if you get assigned at $100, $400, that's basically a $10,000 position. You can also sell a, put option on something cheap like American Airlines. That would be $1,400 if the strike is 14. So a covered call means that you already have the cash set aside in the account as well. So whether it's selling a put option, you do need to have the cash set aside, or a covered call option, you need to have 100 shares of stock. So again, this is a capital intensive strategy. So you will want to have a stock 100 shares of. So like that could be Palantir, that could be anything that you can afford 100 shares of, or vice versa. If you're just going to sell a put option to get into the strategy, then again, you need to have that cash laying around. If those are too expensive for you, you do have to look for the cheaper strategies that I will cover later on in this course. The point of the wheel strategy is that you're never afraid to get assigned. You are never ever afraid to get assigned. So if you sell a put option, you're perfectly happy to get assigned 100 shares. If you get assigned and you have those shares, you sell a covered call. If the covered call gets assigned, you lose your shares. You're also perfectly happy. You're just generating income on both sides. You're generating income from puts. You're also generating income from selling covered calls. So you should never be frustrated or upset if you sold a put option, you get assigned. Yes, it can go very into the money and that can be difficult to run the wheel strategy, but in like basically 90% of cases, it'll be very easy to run the wheel. So I wouldn't really worry about it, especially if you're using high quality companies. Once you've chosen the stock that you like, now you have to pick a put contract with a relatively safe strike price with an expiration date of 30 to 40 days. You can use shorter term expirations. You can also use longer term expirations. I prefer to go for monthly income, so I will pick an expiration date that's 30 days out. And also my sweet spot delta will be about 30 as well. So after working for Goldman Sachs, looking at lots of research reports, what I realized was that selling put options to run the wheel strategy is specifically very good in volatile markets, because when volatility is high, selling options is better. When the market goes down, you make more money than an average stock investor does using the wheel strategy, because selling puts to get into a stock already gives you that margin of safety as well as cushion, because when you're selling a 30 delta put option, or let's say you can also sell 25 delta, anywhere between 20 and 30 delta is a really good sweet spot. You'll actually get assigned about 3 out of 10 times on a 30 delta. If you're doing a 20 delta, you'll get assigned about 2 out of 10 times. Obviously, the less out of the money your strike price is, the higher premium you're going to collect. But in general, and especially for beginners, the wheel strategy is not about getting greedy. It's about safe, consistent returns. So you generally want to pick a strike price kind of far out of the money. You can also go under 20 delta. You will get paid a lot less. If you have a bigger portfolio, this will favor you. Now, if you have a smaller portfolio, you may even decide to go a little bit higher than 30 delta because you get paid more. The most important thing isn't how many dollars it is out of the money, but how likely it is to go into the money. So again, you can go $1 out of the money. That could be really good for a cheap stock like American Airlines. That could also be not that far out of the money for a more expensive stock like Tesla. So it's not necessarily how many dollars you got out of the money, it's how far away you go as a percentage basis. The risk in option trading is that in the short term, you may get unlucky, but in the long term, if you're using the strategies that I'm teaching, you are going to be very successful over a longer period of time. Just like in a casino. If you were to go to a casino and you were to make one big bet, that's actually very scary for the casino because the casino could lose in the short term. However, if you go to the casino and you just keep doing $10 bets over 1,000 times, you are virtually guaranteed to lose because the casino has a small edge. So what I'm teaching mostly on my channel is actually option selling, because option selling makes you the casino. You become in the power seat where you're making consistent income using the strategies and the techniques that I'm teaching you because I know that they work. So when you sell a put option, that option is going to decay every single day. You can buy it back at any point because there is theta decay. That option is becoming less valuable. And because it's becoming less valuable, that's a really good thing for you because you're able to buy back that position for a gain. As long as all things stay even, that theta will be kicking in. Of course, if that stock goes down, then your put option may be at a slight loss, which again is fine. If you take assignment, you have 100 shares now, and you're in the perfect seat to do covered calls. Okay, to explain the expiration date, 30 to 40 days is a pretty normal expiration. Anything much longer than that, and we're starting to get into the risky territory because so much can happen past 40 days. The thing is, you can sell puts that are beyond 40 days. This really depends because if you're picking a high quality stock, you really don't mind. So you can do longer term options and you will actually get compensated more. So when you go out, that's 60 days, 90 days, or multiple months, the compensation to you comes faster because you have to take all that upfront risk right away. However, I will say that the most profitable trading is between 1 to 6 weeks. That's because that's when theta really kicks in. You can see a chart right now on this screen. Theta really speeds up towards expiration. So as expiration approaches, the theta is becoming more and more. This means that the option is decaying in value. Again, if you're an option seller, which is what the wheel strategy is about, then this actually benefits you. If you're an option buyer, this is why buying options is better to go out longer term, because there's a lot more that can happen. However, I will say that one of my strategies is to buy shorter term calls, but that's a more advanced lesson than this course. Anything shorter than 30 or 40 days and the premium isn't going to be that good. However, the expiration is so short, so you can do that many times. You're going to want to experiment with this. Again, for me, it's 1 to 6 weeks, and there's much more that goes into it. I also like to really understand the stocks that I'm paying attention to, and my list of stocks is only about 25 or 30 stocks. That way, I can make really good decisions and keep trading the same stocks over and over again. So once you find a strike price with a delta around that range and that expiration date, it's time to sell the put option. This is of course the most fun part, where you get to collect your premium upfront, and then as soon as you collect the payment, you should be watching your position to see if the stock price starts getting close to your strike price. In most cases, it's really not going to do anything. When you sell an out of the money put, most stocks just typically go sideways, because most days stocks are not really moving that much. Sure, they might move 0.5%, 1%, but if you're selling a 3 or 4 or 5% out of the money put option, in most cases, you actually don't really need to do much. You can monitor the trade every few days, but you do not have to look at it all the time. In fact, I have so many students that are doctors, dentists, lawyers, software engineers. They're very busy professionals. They're already making a high income. So even when they do make $10,000 per month doing option trading, they still have a very busy life. So they don't necessarily want to look at their portfolio. And I always tell them that's completely fine. You're not going to get better results by being obsessive over your portfolio. The fact of the matter is actually really good to set a position and just completely forget about it. You can check on it every couple of times per week. It's also not really worth rolling this type of position, because since your goal is to get assigned, I typically would not roll a short put position or a sell put position, because I'm happy to own it. Unless I, for some reason, change my mind about the stock, or I slightly want to have a different entry point, then I can roll it using the dog strategy. But in most cases, this is not necessary at all, because once you get assigned, you can do covered calls. And by the way, I would also do covered calls around a 20 to 30 delta. I have just found that that is a sweet spot for me. So after that, if the option goes into the money again on the covered call, you do have a decision here. You don't have to lose your shares, because oftentimes you'll be generating a lot of money with the wheel strategy. And if you're up a lot on the stock, then you might not want to get rid of it. You may say to yourself, hey, I want to hang on to this. That's where rolling comes in. You can roll the in the money covered call. You can roll it up. You might not roll it up to become out of the money, but you can roll an in the money option up until it becomes out of the money. You can do that on a weekly basis. You can do that on a monthly basis, or you can even go farther than that. The whole goal is that you're going to be stepping up and rolling up if you don't want to lose the stock. If you're okay losing the stock, that's perfectly fine as well.
So who should be using the wheel strategy? Those that are tired of day trading and guessing and chasing hype stocks and maybe making money one day, and then the next day it's just up and down, right? Especially right now in this market, there's a lot of volatility. If stocks fall several percentage points with the wheel strategy, you will also fall, but you will be far better off than just people that are investing in hype stocks, people that are just investing in stocks in general, because the wheel strategy gives you cushion, it gives you protection. Preferably, you have $10,000 or more so you can properly diversify your portfolio. The bigger your portfolio, the more you can run the wheel strategy and the more stocks you can run the wheel strategy on. So you should be comfortable owning stocks for weeks or months at a time. You need the discipline to follow a system rather than chasing quick profits. Most importantly, you should want consistent income rather than just home run trades. The wheel strategy will not hit any home runs because it's very consistent, it's very safe, but it's not a high risk, it's not a high return strategy. It's not. So you're not going to be making any home run plays here. The wheel strategy is not for people who can't handle seeing their stocks get called away from them either. So if a stock rockets higher, say you have Nvidia stock, you just love this stock like I do, and I've been an Nvidia investor very early on. If that stock skyrockets 30, 40%, you are going to miss on some upside. So I want to be very honest with you on the strengths of this strategy as well as the weaknesses. And we'll talk more about managing this strategy and entering it and closing it and all the potential adjustments that you can make later on with real life examples. This strategy is not really for people who panic when getting assigned shares and maybe the stock drops. Although I would arguably say that investing is just really not for you if you're in that type of position anyways, no matter what type of investing you do. And this is the safest form. So Yeah, you understand, right? So it's not for people who need their investment capital back on a daily basis. This strategy can lock up capital for 1 week or for 1 month. You do get to decide that. And as we see in my examples, I'll be mostly focusing on monthly income. I like generating monthly income because then you can use that income to fund your lifestyle and, to feed your family and to travel and all the other things that you may want to do with your money. Now, let's talk about market conditions because these heavily impact returns. In a sideways to slow trending market, the wheel strategy is amazing. It actually thrives because the stocks are in a predictable range and the wheel strategy profits off of selling options. In a strong bullish market, you might underperform a buy and hold strategy because your upside is capped by covered calls. In bear markets, the premium income provided only a small cushion against some of the losses. However, because you're selling out of the money options, you also get to save the percentage that you're selling out of the money. Risk in the wheel strategy is different from buy and hold, but not necessarily less. When you own stocks, your risk is the stock drops. With the wheel strategy, your risk is the stock drops below your put strike when you're selling a put option, or the stock shooting up past your call strike when selling a call option. The premium that you collect provides a small buffer, but it doesn't eliminate risk. You are not immune to market risk. Now, let's talk more about diversification. This is very important in your stock selection. Sector diversification matters, even in the wheel strategy. Don't run the wheel on 5 different tech stocks. If tech crashes, all your positions will get hit all at once. Mix it up. Maybe it's 1 or 2 tech stocks, financial stocks, consumer goods stocks, maybe healthcare. Maybe it's one of the big healthcare companies that you don't need to understand, but you can hold as a form of safe investment in your portfolio. This way, sector-specific bad news doesn't wreck your entire portfolio in one event. Here's my simple checklist for evaluating a wheel candidate. Does it require less than 10 to 20% of your account to do cash secured puts? Is the implied volatility between 30 to 60%? Would I hold the stock for a year if I had to? Are the option spreads reasonably tight? Do I understand the business? Has it avoided major gaps recently? If I get 6 yes answers, that is a fantastic wheel candidate. Let's talk about the Greeks and let's simplify it as it comes to the wheel strategy. The Greeks are mathematical measurements that tell you how your option position will behave, but don't worry about it if you don't like math. Trust me, you don't need to be good at math to be good at the wheel. For the wheel strategy, you really only need to understand 2 Greeks, delta and theta. I'll touch on the others, but these 2 are the most important that matter. The others sort of matter, but they're not really going to change your profits or losses that much. Delta measures 2 things, okay? First is how much the option price changes when the stock moves by $1. Second is the more important one for us. Delta approximates the probability of the option expiring in the money. 30 delta means 30% chance of it expiring in the money. This second use is why delta is crucial for the wheel strategy. When selling puts in the wheel strategy, we typically target around a 30 delta. The negative sign or negative 30 just means that it is an option that we sold. So don't be concerned about negative 30 delta or positive 30 delta. It's a negative 30 delta because we're selling a put option. So the 30 delta means approximately 30 chance of assignment, 30%. And if you reverse that, it means that there is a 70% chance of keeping our full premium without assignment. So let's see this with Microsoft at $500. A 480 put option might have something like a 30 delta. This may pay $7. A 490 put might have a 40 delta and pay $10. The 495 put might have a 45 delta and pay $12.50. The closer to the money you get, the higher the delta and the more you are compensated. This is a constant trade-off in the wheel strategy and all option trading. The closer the option is to the money, the more risk it has for getting assigned. The more risk it has, the higher the delta. The higher the delta, the higher the premium. Delta changes as the stock moves, which is important to monitor. If Microsoft drops from say 500 down to 45, the 480 put might go from a 30 delta to a 45 delta. 50 delta, by the way, is usually at the money, okay? It's usually when an option is right at that strike price, that's usually about a 50 delta because there's a 50-50 chance. And funny enough, trading is random in the short term. Stock price movement is random. No matter what people tell you about, it's predictable. Stocks going up and down is not predictable. It is not. So when you look at an option, because it's based off of statistics and randomness, which is what the market is, at the money is going to almost always have about a 50 delta. Now let's talk about Theta. This is our best friend, man. We're so excited. We're like, hey Theta, how's it going? How you doing today? Yeah, good to see you. Theta is our best friend in the wheel strategy. It measures how much value the option loses each day from time decay. When we sell options, Theta works for us, eroding the value of what we sold it for, right? But when we sold and collected the money up front, we like to see it erode. All right, let's get into the next chapter, which is going to be position sizing. This is what makes me very different from all the other YouTube coaches out, guys that have been, looking at making fun videos and what stocks are going to go up and down. They may look like experts, but only someone that talks about position sizing and risk management is the true coach, because I've been through this. I've been through some really tough times, both in practice while actually trading, but also in the classroom. So I have a degree in finance, economics, and analytics. And there I had many classes that were in risk management. In fact, my very first job on Wall Street was working for a company called Group 1 Trading, and that was on the New York Stock Exchange. And I was sitting there on the seats of the New York Stock Exchange where lots of traders are making really big positions. And I was looking at any mistakes they may make, and I was sitting next to a risk manager who was essentially making sure that the trader doesn't lose too much money for the firm, because at the end of the day, the firm cares about their profits, not so much the trader himself. He's just an employee at a trading company, right? So I was sitting there and I got to really dig deep into risk management. And the most important thing for risk management, let's dive really deep into this right now, is simply position sizing. Position sizing will make or break your wheel strategy results, because if you go too heavy into one single position, it may be all good until maybe it's not all good, right? So if you have too big of a position, you can get into very hot water. So too big and one bad trade can wipe out a lot of the good gains that you have been making. Okay, if you've been making consistent gains and you have one bad play, that can do some damage to your portfolio. So too small is also not really good, because it's going to waste your time. You don't want to be working for pennies, but I think most beginners, they usually go for too big, right? Too small is a kind of a good thing in a way. If you're learning, then you want to go too small at first, but usually it's people getting into hot water by going too big. So let's get into the exact framework for sizing your position correctly. The golden rule is to never, ever put more than 20% of your money into any single one wheel position unless you are very confident about your thesis. And it's better to put 10% of your money per position. If you're really confident in your thesis, that's fine. But most of the time, in most cases, you're not going to be able to predict the stock. So you want to end up balancing your trades. You want to have diversification. This is very common. It's talked about in almost all investing circles. Diversification is super important. If you have a smaller account, it may be difficult to have diversification. If you're only trading with $10,000, even one sell put position on SoFi at $28 per share is going to be $2,800. So you're going to have 28% of your money in one position. And to that, I don't really have an answer. If you're trading a very small portfolio, well, you're not going to be able to follow all my rules perfectly. So that's why it is good to have $20,000, $25,000 as a portfolio size to begin running the wheel strategy. But if you have a smaller account size, that's fine. You're just going to be breaking some rules around position sizing. And that's fine, because if you have a small portfolio, if it's a little bit bigger, it is what it is, really. So either way though, you want to understand that your ideal is 10% per position. Some positions might be 12%, while other positions that are a bit riskier can be 7 or 6% of your portfolio. It might seem overly conservative when I say like 6 or 7%, but I'm telling you, it's going to be saving you thousands of dollars and pretty much emotional breakdowns when you have too big of a position. And that rare occasion when that stock really breaks down, that's when the real mistakes come. And that's really when those mistakes happen. Why? Because most people do get emotional when they have a big pullback in their portfolio. It doesn't feel good. Even if you're running the wheel strategy, even if you like the stock, believe me, if you have too much in one stock, you're not going to feel very good about it, even if it's the best stock in the world, say Apple. And that's because stocks can correct, stocks can crash. Yes, it's very rare for a high quality company to pull back tremendously, but it happens. You always have to think about the worst case scenario. And if the stock were to pull back, say 10, 15%, would you be okay holding? Are you going to be properly positioning your portfolio for diversity, or will this position end up eating a lot of your total portfolio value? If you have everything in one position and it crashes, well, you're going to be in a tough spot and you're going to be finished, okay? And that's the biggest issue with option trading is if you're a beginner, you probably are, if you're watching my videos right now and you're trying to learn, you're trying to really understand how to trade options. The most important thing is staying alive. This is some unique tips and advice and viewpoint, but the most important thing is staying alive, because the strategy that I'm teaching you in this video, the wheel strategy, focuses on collecting income. If you're collecting income on high quality stocks, you are going to make profits over time, pretty much, in my opinion, like 99% of the time, right? In the long term. Because any 10-year period in the stock market, 99% of the time has been profitable. And I believe 100% of any 15-year period has been profitable, okay? So if you are running the wheel strategy and you are selling puts on high quality stocks and you have 10 different stocks, your portfolio should generate strong income. And over a long period of time, the market always goes up. That is statistically the truth. That the stock market has been around for well over like 100 years, and it has been rising every single decade, even during market crashes such as the 2008 financial crisis, 2000 market bubble. The market fell down, but then it recovered, right? We're at all-time highs. No matter when we have a conversation, no matter when you're watching my video, we're likely not that far from all-time highs. And if you're like, is that true or not? Just look at 2008. Are we higher than 2008 today? You bet. A lot higher, especially when you factor in dividends from the stock market. If you're in S&P 500 ETF or just the general market, we're up a lot more. So what can actually happen if you don't have your position sizing correct? You will end up losing a lot of money. And if you end up losing a lot of money, you may quit option trading, which means that you quit your dreams and your goals of creating passive income online in the most simple method possible. So that's why I'm telling you, the biggest advice that I have is try not to lose money, is have proper position sizing and stay alive, because if you continue to invest, you will build wealth over time. Might not be in a day or a week or a month, but long term, you will make money. So if you have 5 positions and one crashes, that's gonna hurt. But if you have 10 positions and one crashes, you're gonna have a far better chance of recovering your money. Even though it's pretty difficult to lose on the wheel strategy, sometimes you may change your mind and say, hey, this is not a position that I want to be invested in.
So why do most people never become wealthy? Well, it's all about their behaviors and not the stocks themselves. Most people chase exciting opportunities instead of actual consistency. They want to increase their portfolio way too fast without actually building cash flow. That's one of the biggest mistakes. They confuse activity with progress. When someone enters my coaching program, I oftentimes see that they want to place in a ton of trades. But the reality of things is having 10 to 15 stocks in your portfolio and using the right option strategies is far better than over trading. So investing is boring if you're doing it right, and cash flow is super important versus net worth. Answer this question: would you rather own a $1 million painting or a business that sends you $20,000 every single month? Yeah, probably the business that sends you $20,000 every single month. Despite the $1 million painting being very valuable, it is more valuable to have cash flow. At least I'm guessing that you picked the cash flow option. So having cash flow in your portfolio is really a matter of selling options. If you stick more to selling options, that is what produces cash flow. Whereas buying options is more of that growth. If you have more growth in your portfolio, that's great. And I have personally had a year in my own portfolio where I grew $100,000 into $700,000. And when I was on that journey, this was back in 2021, it was great because I knew that having a bigger portfolio would generate me enough cash flow. And that exact year, I ended up leaving America and traveling a lot. But what allowed me to actually feel free enough to travel and, not be tied down to one place wasn't necessarily that I had $700,000. It was more so what I could do with the $700,000, which I knew that if I were to sell options and based off of my own track record, that I would be generating around $20,000 to $25,000 $5,000 per month, which for me was definitely enough to travel, and I was a younger guy. From a common theme of meeting many millionaires and multimillionaires, I see that the rich, they buy freedom. So I see a lot of rich people, for example, buying time, okay? They don't want to have an office. A lot of rich people own real estate. And option trading is very similar to real estate, because if you generate enough cash flow, then you have time freedom. I see so many people traveling, either they're single and they're, divorced men, or they're traveling with their wives on vacation. And a common theme is they're able to enjoy their time without, looking at their watch or having meetings or, business calls. Also, I see a lot of people buying flexibility. So by having enough money, they buy flexibility. Maybe it's upgrading to nicer hotel rooms or nicer flights whenever you're traveling, and really just buying more optionality for themselves. So they never have to worry about, grocery prices or going to an expensive restaurant or anything like that. And just honestly taking a random Tuesday afternoon off is already freedom. If you can just take a random day in the middle of the week off and not have to work and just enjoy the day, then that is freedom. So for me, it was really awesome becoming consistent with options, because the consistency in option trading gave me the time freedom, the flexibility, and the optionality to visit different countries, eat different foods that I like, and not really have to worry about, eventually having to go back into the workforce. For me, when I left Goldman Sachs, when I left Wall Street, I started trading options. And yes, the stock market was in a good place in 2021, and in 2026, it's a little bit more volatile, but I still think it's possible for anyone with the right skill set, with the right strategy, with the right mindset to really create a stable and consistent income stream that really takes care of, all their basic needs, and even some of the higher up needs as well, like maybe purchasing a new house and paying off a mortgage. Option trading, I have seen so many of my students that, they didn't think it was even possible. And then they come into the program, and that within the first 3 months, they're seeing their portfolio generate an income that they didn't even think was possible. And really comes down to consistency. I think that's what makes a lot of people internally happy, when they see consistency and they start believing and understanding that this is something that's really possible. Learning this really is a blessing. For me, learning option trading has completely changed my life beyond what I even expected. And I knew that option trading was a way that made people wealthy. I knew back in college that studying finance and people in finance make a lot of money, but I couldn't really imagine the amount of freedom and options it actually gives you. So consistency is probably the most underrated skill in the entire investing world. Everyone talks about finding the next Nvidia, the next Palantir, or the next stock that's go to the moon, but very few people talk about the mindset that actually builds wealth over decades. The truth is that investing, it's not really won by the person who has the most incredible trade. It's won by the person who simply keeps showing up year after year, and really without making a catastrophic mistake. My first 3 years of trading was good, but not that good. My first 3 years was pretty shaky, and I was making a ton of mistakes. And over a decade ago, one of my favorite stocks was Yelp. Yeah, crazy, right? And Yelp was super volatile, and I was trading options on Yelp, and I just couldn't really find the stability. And that's because at first I was chasing premium. I was making the common mistake that I talk about in this course, is I was chasing premium. So really, you don't want to be that type of guy. You want to think about it as a professional athlete. We celebrate the players who hits a game-winning shot, but we ignore the thousands of hours that they spend practicing the same fundamentals over and over again. And also, there's so many athletes in the sports, whether it's baseball or basketball or tennis or whatever, there's so many successful athletes, but we only look at the top athlete because he's the most popular, right? So we look at the best athlete, Messi, right? But there's so many other soccer players, and they're doing extremely well as well, right? They're athletes. So like Michael Jordan, he didn't become Michael Jordan because of one spectacular game. He became a great because he practiced consistently for years. Investing is exactly the same. One of the biggest mistakes I see is people constantly changing strategies. One month they're buying meme stocks, the next month they're trying to day trade, and then they're just buying options because someone on YouTube promised that they can turn 5,000 into 100,000, which honestly is not possible in a short amount of time. That's way too risky. And as many people as there are on YouTube saying that that's possible, it's really not. So 6 months later, they're becoming someone that's interested in crypto because they think that's possible to get rich quick, and they never really go with the consistency. Too many people have a lot of false beliefs, and social media has us on this toxic wheel of believing that, everyone could be successful in a short amount of time. But the truth is, money is pretty difficult to come by, right? A lot of people that even become very rich cannot even keep their money. So my recommendation is become consistent. Learn from someone like myself who's been doing this for 12 years that honestly, it took time, it took a lot of dedication, but it was well worth it to be a consistent and stable, more income trader rather than a gambler trying to look for a home run. Imagine planting a fruit tree or something, right? You water it every day for 6 months and then you decide that it's taking too long, so you end up digging it up and planting a different tree. I mean, that's exactly what people are doing. 6 months later, they do the same thing. If the tree didn't grow fast enough, they just end up replanting it. And 10 years go by and they still don't have any fruit because every time that growth is even taking place, they decide that, the growth is too small and it's not fast enough and this tree isn't growing quick enough, so I'm gonna replant and maybe I'll find a different tree. It's exactly how many investors approach the market. Compounding only works if you stay invested long enough to experience it. Warren Buffett did not become one of the wealthiest investors because he founded hundreds of incredible investments every year. He didn't find hundreds of incredible investments. He became wealthy because he allowed 1 or 2 great investments to compound over an incredibly long period of time. And time was just as important as the stock selection. Again, I think social media has created unrealistic expectations. We constantly see screenshots of someone making $50,000 overnight or turning a small amount of money into something huge. What you don't see is that thousands of people who try the same exact thing and honestly, they end up losing money. And oftentimes, a lot of the testimonials that you see on YouTube are just plain fake. And I don't even like looking at testimonials and reviews because there's tons of fake stuff out there. At the end of the day, you have to become confident, get a strategy, and go through the tough times and not give up during tough or boring times. Boring doesn't go viral. So you don't see any YouTube videos that are talking about boring strategies. That's because it doesn't go viral on social media and it doesn't make sense for the creator to make that video. Nobody here on YouTube is going to make a video like, hey, I made, $100 for, the past couple of days, because nobody's going to click or watch that video. And that means that that creator is going to spend their time and effort and it's going to go to waste. And all the creators on the platform, they're trying to sell courses. I'm just being honest with you. I'm telling you everything that I can right now to actually make a difference in your life, even if it's brutally honest and even hurts me, because I myself sell coaching. And right now I'm talking down on coaching. And that's because consistency, it doesn't require watching YouTube videos or paying attention to the market consistently, right? That is actually a huge fallacy. Once you have a strategy, it's like the strategy of going to the gym. Once you know what you're doing, you don't need to watch 1,000 videos on how to do a bicep curl, right? You just go and you do your thing at the gym, and you have to make sure that you're at the gym every single day. Of course, take your rest days as well. Now, one of my favorite analogies is comparing investing, of course, to going to the gym, because I always say, let's make money bicep over tricep in a lot of my videos. I stop because I see some of the bad comments, but sometimes when I'm in a good mood, I tell you guys, bicep over tricep. That's because I want you to get excited about opportunities in the market, because even in down markets, as we discussed in this course, there are plenty of opportunities and there's ways to make money when the market is going down. It's all about spotting opportunity and having the right strategy for whatever is about to happen, right? And there are many obvious signs in the market whenever the market is crumbling. Nobody expects to work out, for 1 week and then suddenly have the body that they've always wanted. Well, the same thing in the market. You can't just expect the market to be always good. Even when the market is coming down, your goal should be to outperform the market, to save yourself money on the downside by hedging your portfolio. This is exactly what I talk about in my one-on-one coaching. Oftentimes we look at the market and whenever there's tough times, people are losing hope, but that's when I step in and I remind them that this is the time to hedge, this is the time to protect, and honestly, this is the time to take some risk and bet that the market may fall lower, because if it falls lower, well, we make money off that, right? So this is why I don't obsess over making the maximum amount of money on every single trade. That's because there's going to be months in the market where instead of having a good return, sometimes I make 8% in a month, and then other times I might have a 2% month, and that's not a month that I need to get upset about. 2% can still be an amazing amount on a decent sized portfolio. But if you have a smaller portfolio, you're like, this doesn't even cover my basic gas. I can't even, get to work because this is not making me enough money. That's fine, right? We all have to start somewhere, and as we scale, even a small percentage makes a big difference. And again, it's all about consistency. There's also why I prefer having rules instead of emotions. Before I enter a position, I already know how much I'm willing to risk. I already know when I'm going to take profit. I already know when I'm going to close a trade. And those decisions aren't made during stressful moments because emotions are honestly terrible whenever the market's going down. But again, I'm going to hammer this home. Consistency, having a plan in place. People often ask me, what is the secret to becoming wealthy? Honestly, I think it's much simpler than most people expect. Save consistently, invest consistently, continue learning consistently, and avoid major mistakes. Repeat that process for years instead of days or weeks. Yeah, I get it. It's not exciting, but this is a long-term journey. And this is what I've been doing for the past 6 years in terms of coaching and 12 years in terms of personally. And now that I have been doing this for 12 years, I have seen that the market doesn't reward excitement. It rewards discipline. It rewards patience. So at the end of the day, consistency isn't just about investing. It's about becoming the type of person who keeps their promises to themselves. Every time you stick to your investment plan instead of chasing the latest trend, you are building confidence. Remember, your goal isn't to have one amazing year. Your goal is to build a financial life that works for the next 30 or even 40 years, that takes care of you in your entirety of retirement. Slow progress that compounds is infinitely more powerful than fast progress that disappears. In investing, consistency is the most important factor to compounding. It is literally unbelievable what every single dollar does over a long period of time. All right, now I want to go over 2 more people that I have helped recently and the messages that I have received from them. And I just want to show you both of these, and then I'll talk a little bit more about the strategy that I believe is the most powerful strategy, which I believe to be the wheel strategy and how I optimize the wheel strategy. So look, this is the first client that I have, Gia. So we were working on Palantir. She did really well on Palantir, and then you can see here she said, "Thanks, Henry. I'm glad you gave me the call without selling covered calls on it." So what I specifically did for the wheel strategy with Palantir was because I had an idea that it would probably go up post earnings. I thought that Palantir was extremely undervalued at $109 per share. I was telling my community every single day. I was being actually pretty annoying about it. I was like, guys, Palantir's undervalued. Palantir's undervalued. Every single day, people would ask me questions about other stocks. I would say Palantir is my highest conviction play, and it really ran up, as we can tell from, you just search it up. And I'm very happy because I did not sell covered calls, because if I did sell covered calls, I would limit myself. So Gia, I think she's even happier than you can see in the messages, but she's really happy with Palantir. But here's what I said, okay, now that it ran up post earnings over 175, just sell a covered call now at 175. So there is a timing component to running the wheel strategy. It can be very important not to sell yourself short. So she did sell 3 contracts, 1759 total premium collected, and we're going out for August 21st. So it might already be August 21st by the time I edit this full free course for you guys. But that's the first person, and the second person is Greg. He showed me like a win before that, but anyways, we're going to focus on, like I said, strong support at 200. Let's sell more puts. September 18th is fine. So I like to go for monthly trading, and because I'm already in August right now as I'm making this video, I'm already in like mid-August basically. I like to go 1 month out. That's like the simplest expiration date, as we already discussed in this course. So for your account size, let's do 2 contracts. He has a much bigger account. Greg's in the multi 6-figure range. 2 contracts would be fine for his portfolio. And then it says, oh, it's almost 2 months. And then there's like what we're expecting there. He said noted, similar to SoFi support, he said at 16. Yeah, so we also did SoFi, did Nvidia, Palantir. He actually sent me a trade up here. It's a screenshot, but it was American Airlines. So I can see the average cost, yeah, American Airlines. We did really well with American Airlines wheel strategy, exceptionally well. That stock just goes sideways. So whenever it's like volatile, but it's like range, within a range, we're just absolutely killing it. So yeah, Greg's another happy student of mine. So yeah, we collected 1350 roughly on that. But yeah, that's how I'm running the wheel strategy with my students one-on-one. I'm just sending them messages and I'm going back and forth as needed, really, to support them. So if this is something that you're interested in, if you want my support, really anytime, you just message me. I'll give you trades. We'll manage trades, we'll roll trades, we'll pick strike prices, we'll pick expiration dates, and really everything else that it takes to become a successful option trader. I'd love to help you implement option trading as a retirement strategy and help you either get to retirement, stay in retirement, or really just start planning retirement. Wherever you are in terms of the stages, whether it's stage 1 to 3, I'm happy either way to help you along your journey. It's much better to have a coach. I have several coaches in my own life. When it comes to bodybuilding, I'm trying to get bigger muscles. As you see in the video, sometimes I step over tricep, really trying to work on that. And when it comes to trading, I've been doing it myself for a long time, but I used to have coaches. I had many mentors. So whether it's like relationship, whether it's fitness, whether it's building wealth, I think building wealth, obviously, if you don't have that in order, if you're not where you want to be, if you're not, I would say that my goal was to generate $10,000 a month. And if I wasn't there, I would be looking for help. I would be seeking a mentor who has been there and done that. I've done not $10,000 a month, but I've done 6 figures per month as well in my own journey. And
big part of my journey was scaling from $100,000 to $700,000. And part of that was using leap options. I was looking for more volatile stocks. So there's lots of opportunities in the market depending on what your goals are. I always like to mix in more of that safer approach where risk management is in place, which is more balanced trades with growth trades and other growth opportunities, because I know a lot of people that are trying to grow an account. They want to become retired. They're very far from that end goal, and that's okay. I was there as well, and a lot faster than I believe or thought would happen, I ended up achieving my own personal goals. And I think a lot of my students, like I just showed you with Gia and Greg, that's just 2 examples. I have many more. It's obviously a little bit buried with all the messages that I have. I have over 24 one-on-one students right now that are messaging me anytime throughout the day, messaging them back. We're allocating capital together. So I do have more spots. I have more availability, and I want to help more people. So again, if that's something that you want, go ahead and check out the description. It's one-on-one. Specifically, it's the first link. It'll be one-on-one coaching. Okay. I also have a Discord community, which is the second link in the description, but the first link is one-on-one coaching. The second link is for the Discord community. If you want to be part of the community with other people that are also scaling their portfolio, growing their portfolio, executing option selling strategies, including option buying strategies. There's a lot of different things that I do. So if you're interested in that or have any interest at all, it doesn't cost any money. It doesn't cost you anything to learn more about the program. And if it's not a fit, we will give you a plan to move forward that you can do yourself, or you can have me help you implement it. Either way, thanks so much for watching, and I'll see you in the next one.